All right, so incredible week. I hope everybody had a safe trading week and paid attention to the Fed on Wednesday. I streamed it live. I ended up making a trade that went really, really well during Powell's speech. Ended up being at just the perfect time. I got out at the perfect time, which is not something I usually do. So that was really awesome. But the Fed was pretty much in line with what I was thinking was going to happen. Things took a turn about a week ago for the more bearish and then even more so the days leading up to the Fed meeting. So I figured, all right, this is probably going to be a bigger increase than we thought. Let me go ahead and move this out of the way. I forgot that was there. I thought there was going to be a bigger increase than we were expecting. So I just wanted to be prepared for it. I didn't think the market was going to do what it did the first time the Fed raised rates earlier than in the year. The first time they raised rates and it ended up moving up quite a bit right away, which usually happens, in a better market. So like in 2018, 2017, years like that, while they were raising rates, that's kind of what would happen. It would, squeeze a little bit and then come back down or keep going afterwards. But in this case, because the last time we had a Fed rate announcement, it crashed right after, the day after. So I was expecting for something similar to happen, and that's basically what happened. It went up, it came right back down, and then it kind of went back up to the high of day to close, and it looked like after hours was trending up, but it didn't really last. The next day and the day after, it came right back down, which is why I have this little meme that I've been meaning to share for, I don't know, 3 weeks, 4 weeks, a couple months, whatever it was now. But this is basically what's going on right now. Everybody, I think it was a crypto meme mainly, but it fits with everything because that's kind of what I've been hearing. I keep hearing people saying, "Oh, we're gonna go to the moon. The worst of it's over. It's time to rally." And no, it's not. See, because those people are not paying attention to everything that's going on. Like they're just paying attention to either the charts or the stuff that they're hearing on YouTube or whatever, TikTok especially, with the really bad advice going around there. There's just so much bad advice. And it's easy to get lost in that stuff. It's easy to start thinking to yourself that if things are going to move in the direction that you think they're going to move, or because it's down, it's time to go up. If it goes down, it goes up. That's not always the case. Sometimes that's the case, sometimes it's not. But this week, we had a nice red week and we definitely went to the moon. It's very apt. So let me get this out of here. Okay, so let's get to everything. This was a very interesting week. I ended up making an amazing trade during Powell's speech. That's what I was saying a second ago. So I wanted to talk about that. We've got some macro news, we've got some stock news, we've got some crypto news. The markets are not open right now. Normally, the futures would be going on. But here, let me go to the other screen real quick. I'll show you. It's just there's no activity. See, over here would be the E-minis, the S&P futures, and they are not doing anything. There's no volume, nothing, because we're closed for the new bank holiday of Juneteenth. It's going to be Monday, so the markets will open on Tuesday, which actually means that the futures market will open 3 o'clock Pacific time tomorrow, because they always open the day before the market opens. But let's take a look at what happened. So Powell came out, he gave a speech. The normal thing that happens during Fed meetings happened this time as well. It was exactly what I was expecting to happen. There's some serious volatility when the rates come out, because the rates come out about a half an hour before Powell starts talking. And then once Powell starts talking, there's a dump and a recovery. And then, it kind of goes, it does whatever it does for the rest of the day. But it's basically an S shape. So let me zoom in real quick so we can get a better idea of what actually happened. So let's see this. I'm going to maximize this actually so we can see it a little better. Maximize cells, and let me switch this to a 5-minute chart. 5 days, 5 minutes, because that way you can see the action a little bit better. So let's see, this would have been Friday and Thursday. Let's scroll over here. And we are on the QQQ, which is what I was trading. Okay, so you can tell this was the day right here because look at this volatility. This was going on during the meeting. And by the time it was over, we'd peaked up here. So here is the standard pattern for a Fed meeting. No matter what the market conditions are, what happens the day after, none of that. Throw all that stuff out the window. Just the standard pattern for a Fed meeting, if you ever wanted to do anything with that, would be this right here. I'm on West Coast time, so 11 o'clock is when the rate announcement comes out for me. That would be 2 o'clock Eastern. This was the first 5 minutes of trading during that time. So you can see right there, there's a huge red candle. In fact, let's see if I can zoom in a little bit more here. Where are we? There we go. Okay, here is the Fed meeting. So the first 5 minutes, we have this right here, right? Because they came out and they said 75 basis points was going to be the hike. And originally, people were thinking 50. And actually, even before that, some people were thinking 25. But as time went on, the need for a higher and higher hike came about because we have some serious inflation. The CPI from a week or 2 weeks ago came out at the highest it's been since like 1981. And I think that was about 8.6% year over year for that month. And we'll have to see what happens with next month. But that first candle that came out was right when they announced the 75 basis point hike. So there was a lot of volatility. It went up at first and then it slammed down. And this is the one that you really have to ignore because this is just the algos, all the bots going crazy, making all these different trades. So this, I didn't touch anything at this point. I was doing all this live. I was streaming, so I was kind of talking during all of this, just letting people know this little bounce around range was kind of normal because people don't know what's going to happen. So you don't usually see it move too far in one direction or another the day of. Usually all the movements happen beforehand. And I would say that the last few days of the week before and the first 2 days before the meeting is usually when stuff happens. And then that Wednesday, because it's almost always on a Wednesday, is when you get this. And you'll see the back and forth movement until the rate comes out. And that jump was basically about what you were trading at for most of the day. So it went up, it slammed down, and then it kind of traded in this range right here. You can see all these candles were sort of closing at this point right here around 280. So I made a point during the stream that support and resistance are kind of, they're not so much like walls or ceilings or floors. They're more like, it's more like gravity. It's more like a magnet because you'll see that prices will either, they won't just bounce off of a level, they'll be attracted to it. They'll slam down onto quote support and maybe they'll break through it and then get sucked back up onto support. It's the same way with resistance. Sometimes it'll go up to it, it'll go past and then get pushed back down. And I look at that like gravity, like magnetism. And that's kind of what was going on with this level right here, this 279 on the QQQ. It was every time it went below it, it got rejected and pushed back up. And every time it was above it, it wanted to go right back down. So this was where the pull was. This is where people were feeling safe. And this would have been 5, 10, 15, 20, 25, 30 minutes of basically nothing going on, right? You see, yeah, it was up, it was down, whatever. But in my eyes, this is a flat move that moved straight across. So nothing was going on here. And what that was telling me was that people that the all the action from this candle right here was settling down. So this is where all the volatility was coming out. You don't know which way it's going to go, but then it kind of settles. And you can see this line right here is VWAP, which stands for volume weighted average price. So this is kind of a way to judge the health of the market. If it's below VWAP, then people are a little bearish for the day, or if it's above it, then they're a little bullish. And you can see, beforehand it was up, down, all around VWAP, but then, after the rates came out, it was below it. And then what happened here? So Powell started talking right around here. Where's 11:30? So this candle right here would have been where Powell came out. And of course, he's not like perfectly punctual. He's usually out, 30 seconds, a minute after. So a little bit after 11:30, Powell starts talking and things start to tank because this went down fast. So he started saying stuff, I think within like 3 or 4 minutes, this was already down here. And then it got pushed right back up to here pretty quickly, and it was hanging out for most of this 5-minute candle. So it was like up, down, staying right there. So I thought, okay, he's talking, it's dumped, it didn't go down further. The fact that it already got rejected and was holding pretty well on relatively strong volume. I wouldn't call this really strong volume. I mean, it's definitely higher than the rest of the day. I mean, you could see most of the day was under the volume average, mostly because people were sitting on the sidelines waiting to see what happens. I was describing that during the broadcast as like, fight, flight, or freeze. If there's a predator that jumps out of the bush, you have those three options. And it's kind of the same thing with the Fed meeting. Most people are they're frozen. They're just sitting there waiting to see what's happening with the Fed. So once that came out, yeah, there's a lot of volume on that first candle. In fact, that's where most of the trading started, which again was another reason why I don't like to touch this first candle, why I like to let the rate announcement news kind of work itself out. Because this right here, this straight across line was telling me that there was support. So watching this happen for a half an hour before I was ready to enter a trade gave me confidence to do so. Because a lot of times this will actually drift downwards a little bit. And then once the Fed starts talking, there's a bigger tank than what happened. Usually it really drops right when he starts talking, and you'll usually get a couple of candles. But since this was holding so strong, and when it popped down below it, it came back up so fast that I thought, okay, this looks like it's going to be support. This is a risky trade, but I'm going to go ahead and get in it. So what I ended up doing was buying the QQQ January 15th, 17th, whatever. Let me see what the hold on. We'll see what the date was on these things. So it would have been not January, July 15th. So yeah, I bought the July 15th 292s, which at the time were about 33 delta. So it was 292. So right there. So yeah, I bought these 292s. At the time, they were about 33 delta. What are they right now? They're about 26 delta. Yeah, no surprise because the market's gone down. But I wanted something with a good amount of exposure to catch a pop, which those had. But I didn't want to be too close to the money because I didn't want to risk that much. I mean, these calls at the time before they went up were $500. In fact, I put a $500 limit order in to make sure I got it at exactly that price, which I did, and I got it right away too. The spread was like 8 to 10 cents wide, and I thought, oh, I don't know if I'm gonna get that. But when there's crazy volatility like there is during a Fed meeting, it's a little bit easier to get filled sometimes because people are anxious and they want to get out of things. Either they're up and they just want to take their gain real quick, or they're down and they're afraid of getting smashed even more. So I got that for $500. Like right here, right when it was switching over to this candle. I think this candle may have even been red for a little bit. Yeah, it was because it opened right here. When you see a green candle, you know that it opened at the low of the body and closed at the high of the body. So when it moved over, it was going down a little bit, but it was kind of hanging out down here. I bought those calls for 500, and I'm not kidding you. 12 minutes later, boom, we were up here. This actually right here was where I sold it, kind of at the top of this red candle, because I saw this momentum going up. My calls went up $200 right. I mean, it was so fast. They were up $200 probably by about like right here. I ended up getting a little more than $200 actually out of them. It was close to 50%. It wasn't quite 50% profit, but it was almost 50% profit. And if I had sold up here, it would have been a little more than 50%. These were almost $300 gains at this point, but I lost a good $70-$80 really quickly, and it was kind of struggling and sitting there. So I took the opportunity to just take them off the table because I thought making almost 50% gain in 12 minutes is really good. And it was literally 12 minutes because I looked at the order afterwards. I bought it, at 11:32 or something like that and sold it at 11:44, I think. I have to check those numbers to see exactly, but yeah, this is where I sold it, like right in here. And then for the next 15 minutes, it was dropping, and I thought, oh man, that was a great place to sell. And even though it went higher later in the day, I still think it was a good place to sell because I made my money really quick. Like if you can make 20% in 12 to 15 minutes, that's wonderful. Making 50 is amazing. So I got in on that call right here, wrote it up while Powell was talking. Basically, what he was saying during this point was everything is in line with what you're expecting. And that's why everything rallied. The market was squeezing because the people that were betting on the downward motion weren't going to have that action because Powell came out and said, we raised harder than we expected to, but that's in line with what's going on with inflation. And if you talk to economists, you talk to market professionals, whatever, they all would have said the same thing. They would have said the Fed needs to act a little bit stronger on rates to make sure we stamp down inflation quickly. So that's what he said we're going to do. It's like, we're not panicking. This isn't as bad as some people think it is, but there is reason for concern. So we're raising more than we expected to. They also said that 75-point hikes are not going to be common. We could get another one. In fact, I think we probably are going to get another one at some point because now, which this is really interesting, the new goal for the Fed is 3 to 3.5% by the end of the year. So this isn't just a person here and there or as an analyst projecting this. This is the Fed as a group coming together and saying we think this is what needs to happen. So Powell said, okay, what did he say? He said they're no longer model driven, which is telling you that they're going more on gut instinct than they are on the standard economic models that the Fed would normally use to make these decisions. Because things have gotten out of control, they need to stamp it down quickly before this starts hurting people because you have a couple of problems. Basically, they have the health of the job market versus inflation. And that's kind of what they're doing battle with right now. They're saying, all right, how hard are we going to have to crush the markets in order to stamp down inflation? And more so, how hard are we going to have to crush down the job market to stamp down inflation? So next week, I believe, or sometime coming up pretty soon, Powell's going to appear in front of the House a House hearing, and he's going to have to tell them, and of course he's going to do this diplomatically and use as much Fed speak as possible to confuse people. But he's going to tell them, hey, sorry, we're going to have to prioritize inflation over jobs, so people are going to lose jobs. And if we don't do that, then we're not going to get inflation under control, which unfortunately he's right about. This has gotten so bad that they need to stamp down rates harder in order to make sure that this doesn't get out of control. Because wage growth is part of inflation. People make more money, they can spend more money on things, which drives the cost of goods and services up. And that's part of the problem with inflation, is that strong job markets can lead to that. Now, it's in this case, nor a strong job market by itself isn't necessarily going to do that. It has to be mixed in with a bunch of other factors. And we had everything. We had the perfect storm. We had a record amount of stimulus that was coming into the system. We have supply chain problems slowing things down, driving up prices. We have wage growth from employment returning to what it was before. Everything in there is screaming inflation. So we got this perfect little storm that means the job market is going to have to suffer. So that's going to hurt the stock market a little bit, but it's not going to be a long-term thing. And that's what he's going to have to say next week. So this is going to be a volatile week. It's going to be a rough week for Jerome Powell because he has to basically go in there and tell people who are politicians who will say anything and do anything for their political career, and that usually involves saying we need more jobs, we need to get people working, which is true. That does need to happen. So it's going to be a rough meeting, and I'm expecting some volatility from that, but I'm not going to trade that because I don't know how I could trade that. I only want to go with things that I'm absolutely sure about. In this case, I'm not sure about it. So we've got a few things going on. The producer price inflation or index, which is like the CPI for producers, that was up 8.3%. It was estimated to be 8.6, so that's a little less than expected, but not by much. The last one was 8.8, so it's a little down from that. That's a little bullish, but not. It's close enough to where it really doesn't matter all that much. So a couple of things we have going on this week. Quarterly expiration for options happened this week. This I don't even think they're going to be listed anymore. Let me see the June options. Yeah, so the quarterly options have already expired. So Friday, those options expired. Basically, quarterly options are the biggest in volume. Those are the ones that most people will trade. All these other ones, if you're looking at my screen right now, these ones say weeklies and they're all written in yellow. These have way thinner volume because people don't want to trade these as much. There's more risk to it. There's not a lot of volume to buy or sell into, so it's not the best. So these ones that are in white, like the July 22s, these are the ones you're looking at for the quarterly options. If I can, I will be in these. Once in a while, I'll be in the weeklies, but for the most part, it's going to be these. So when you see, the reason I'm bringing this up is because when you see a contract cycle, it can tell you that maybe there's going to be some movement in the markets, which is important because right now we just had this Fed meeting and it looked afterwards like, hey, everything's up. And then what happened after that? Let me back up a little bit. You can see it just got crushed. So the very next day, this was actually overnight. So it was looking up till the end of the day, kind of had some sputtering out later on. And then when the things opened in the morning, everything kind of came right back down. In fact, this is a 24-hour product, so this never closed. But things started coming back down in the morning. You can see here the next day they went down. It did come up a tiny bit, but it's really still where it was after it came down after the Fed meeting. So that's kind of what we're looking at for next week. Let me go to the bigger chart so we can take a look at everything. These are the cues. I'm going to go ahead and switch this to the SPY so we can get a better idea of the overall market here. So I've got two fancy schmancy little screens here. I started working on getting these set up. I've got one that's completely clean, so you can just look at the price action if you want and the volume. And then I've got one with all the indicators, and it looks like there's way too much grid on this, so I'm going to go ahead and change that. So if you use a Thinkorswim to change the appearance of this stuff, you go over to appearance, and I'm going to actually just make this grid a little bit more transparent so it's easier to see everything that's going on and not get distracted if you have a bright monitor like I do right now, which normally I don't. There we go. So they're still technically there, but just really hard to see. So let me make this full screen real quick and we can get a good look at what's going on with the markets. I don't have chat up right now, so let me expand this and see if anybody... Aha, there we go. Oh, sorry, I didn't see you said anything. Sharky Torre, tomorrow isn't Juneteenth. What the F? Why are markets closed? They're just closing it on that day because it's like the new bank holiday. They just decided that was the day they were going to close it. I don't know. It's new. This is the first year they've done that, so everything is just not going to be open. All right, so we're looking at the SPY here. I put the standard deviation channel back in. I kind of cleaned things up and made the volume and the volume profile a little easier to see. What we're looking at right now is an official bear market. It's actually 20% down from where it was up here on the highs. And that's the definition of a bear market, 20% down. So when people start talking about, oh, it's officially a bear market, etc., that's all it means. We're just 20% down. I'm not too worried about this. Are we going to go lower? Probably. I think it's more likely than not that we continue to go lower. I think the price action from the 2 days after the Fed meeting shows you that. There was a little bit of a recovery on Friday. I mean, it didn't fall further, but at the same time, if you're looking at the weekly timeline like we are right now, you can see it's a pretty down week. I mean, we're not at the very bottom of where we traded, but we're pretty close to it. And you can see we gapped down from the week before. We're down. This is, I believe, this is a half standard. Is this the median right here? Let me back up and see if we're close to that median. No, we're not. That would be one standard deviation up there. Okay, so we've got yeah, the median is way down here at like we'll call it about 300. So right at about 300, we've got the mean price in the standard deviation channel for the length of time that this chart goes, which I think is to the 90s or so when the SPY started. So we are down, we're at just below the one standard deviation. If you look after the pandemic, we crashed below the median and we've been pumping up above it. We actually turned around right at the 2 standard deviation mark, which is really interesting. This is why I like having these standard deviation channels, because you can see that it bounced off right there. And whether that was intentional or not, which I don't think it was, that still is interesting, because that's what it tells you. One standard deviation encompasses like 60, I want to say 68-ish% of all moves, and 2 standard deviations is like 90% of all moves. I think 3 is about 98 or 99. So really, 3 standard deviations should encompass almost every move you're going to see. And realistically, 1 and 2 will. Because a lot of times the one standard deviation will be a turning point. But in this case, because we had such a bullish run with the SPY and we had so much money coming into the markets, it pumps all the way up from below the median to 2 standard deviations up. And we've given away half of that. We've given away one standard deviation, and we're getting close to the half standard dev mark. Because the way I have it is I have the median, I have a half standard dev, I have 1 dev and 2 dev, and then I think there's like a 3 up there too. Once it goes beyond 3, you don't really need to see it anymore, because it's you kind of know. I mean, once it's beyond 3, you're pretty much in weird territory at that point. I also have the simple moving averages. I should have had 4 on here, but it looks like there are 4. It's just hard to see this one right here. So this would be the 200 simple, the 100 simple, the 50, and the 21. And I usually use the simple instead of the exponential because it's a lot more common. And I'm not using these to try to make some fancy trade right away. I'm actually just using them to gauge the health of the market and see what other traders are thinking. So in this case, we are not quite at the 200 week moving average. We have punched below the 100. And actually, if you look at where the 100 is, the past few weeks, that's what we were rubbing up against. Like we'd come up, we'd maybe pop a little bit above it or just hit it and boom, get rejected. We had a big candle, boom, got rejected. So it was showing you that this line right here was actually holding. The 100 standard deviation was important in that case. It wasn't like everybody was looking at that, but it is an area that affects price. So I'm looking at it right now and thinking like, yeah, that actually lines up pretty well. We've got the 2 standard dev bounce up here. We've got the 100 simple moving average, 100 week simple moving average right here, punching it down. Now the next thing we're looking at is this 1 standard deviation mark or the 200 week moving average. It's in between both of those, so it could go either way. My guess is by the action, it's probably going to drift down. I don't know if we're going to have a huge panic from here, because I mean, if you look at these other drops, usually when there's a nice big gap like that, we either have extreme movement or it just kind of starts to settle. Like the gaps usually tell you that the momentum. It doesn't tell you that the momentum is slowing, but when you have those big gaps and you have a lot of wicks on them like this, it can tell you that there's uncertainty and we might be nearing a bottom. And if you look at this, it bounced basically a little bit. We went below the half standard deviation down and came back. So that's why I like these channels. I'm not that big into technical analysis, but I do like these kind of things because they work on more of a broad. They work with a broad brush. Like it's hard to make day trades based on this stuff. I only like making day trades based on information that I actually have. For example, the Fed meeting. That was one that was a high probability trade in my opinion, because I've watched a lot of these Fed meetings and the same thing usually happens. I would say 8 times out of 10, 80% of the time, that pattern that I showed you with the volatile, first 5 minute candle settling and then a down up when Powell's talking, that happens most of the time. So I like these higher odds plays, and using the technical analysis like this will give me a little bit of confidence, but I don't want to act on it unless I have some fundamental reason to act on it as well. And that's kind of what I'm looking at right here. Is this is down? We've got some technical reasons for it to go either way, but what are the fundamental reasons for the movement? And the fundamental reason for the movement downward, in my opinion, is the fact that the Fed has admitted that they have to step it up, which we knew they were going to do, and they are more aggressive than we were initially expecting. But as expectations changed, they moved their forecast in line with people's expectations. So let me pull this up real quick. I actually have a picture of the Fed dot plot, which is their measure of where inflation is supposed to be. So you can see right here. Let me actually make this full screen. Well, like it doesn't matter. It's really small. So you can see right here at the end of 2022, they're putting rates somewhere around 3%. Right, between 3 and 3.75%. So each one of these dots is a different member's projection. So most of them are actually right about here, around 340 or 3.4 or so. But anywhere from 3 to 375 ish, 380 is where they're thinking they're going to be by the end of the year. But then you look at next year and they're even higher. So from what I saw, the expectation was 3 to 3.5% by the end of 2022, and 3.5 to 4% by the end of 2023, with possible relaxing rates in 2024. So originally we were thinking that they would have to jack rates up this year and then they would calm down next year. But at this point, it doesn't look like that's going to actually happen. It looks like they're going to keep pushing up rates for the next year and a half, which is probably what they're going to have to do. Now, if things clear up, like the war in the Ukraine is the big one because that's affecting the most volatile parts of commodity prices. Energy and food are the two most volatile sectors in commodities, which is why when they released the CPI, they released two numbers. They released the headline, which has everything, and then they released core, which doesn't include food or energy, so that you get a more accurate picture of what inflation actually looks like, those things withstanding. So if the war in Ukraine were to end soon, that would help both of those sectors. Mostly it would help with oil, but it would help with a lot of the food commodities too. I mean, you think about how much wheat Russia produces and other things. Fertilizer is a big one. Farmers have been having trouble getting enough fertilizer. So the war in Ukraine is basically one of the main drivers of inflation right now because the things it's affecting are the most sensitive things to inflation. So they're expecting to get much more bearish if this drags out. But if it doesn't, then these projections right here aren't going to be accurate anymore. If the war ends tomorrow, then they're going to bring these projections down for the next meeting, and they probably won't raise as high as they would if everything stays the way it is. So that's kind of what we're looking at. We have a longer set of raises than we expected, so we're going to stay up in this painful area for a little bit longer and then slowly come back down. So basically, they're looking to get things back down to around 2%, which is, roughly historically where they want it to be in recent years, by 2025 or later. This is long term. It doesn't necessarily mean 2025. It just means somewhere in this distant future here. So that was one thing that told me there's more pressure than expected. So that's bearish for the markets, right? Well, the more you jack up rates, the lower stocks are going to have to go. The other thing is Powell is basically going to crush any rally that happens, right? That's what these rates and their quantitative tightening is going to do. Rates will bring things down. And the harder they are on that, plus their winding down of their balance sheet, the quicker they can get this over with, which I think is something that a lot of people aren't thinking about. I think a lot of people expect this to last a long, long time, especially if you watch the political shows and they tell you that, everything's bad and we're all dying and stuff like that. You're going to see a lot more of the bearish stance from that sector of the media. But in reality, things are going to hit a breaking point. Like we think we've seen some high volatility now, which we have seen some high volatility. But I think what's going to actually happen is reality is going to set in as they tighten harder and harder if things continue to stay the way they are, and then we're going to have a nice drop through this thin volume, because if you look at right where we are, we're kind of at the bottom of this little bump on the volume profile. So the volume profile just gives you an idea of where people bought in. Right. So down here, a lot of people bought in. So at this price, and you can see this was a very volatile price. Remember what I was saying about a magnet or gravity? If you put a line straight through right there, you can kind of see that it was above and below that, and it was pulled towards it, depending upon the side it was on at the time. And when the pandemic happened, that was the point it crashed through and came up quickly, because you can see when things started to slow down was when it got to this heavy volume point. So this was a point where a lot of people decided to buy in, or a lot of scared people decided to get out. So there's a lot of volume down here. We've got hopefully nice support there. That will be an area that I would be looking for in a worst case scenario. Well, I mean, worst case scenario, I'd say we'd be puncturing way down here into even thicker volume, but a more likely worst case scenario. So it's like worst case scenario light will be right about here. My expectation is that if we drop, we crush through this thin volume right here because there's nothing basically. Then we start getting into the heavier stuff, and like the farther we go, the thicker the weeds get, and the slower we should move down because there are all these people that got in here. So you have to think a lot of people got in during that pandemic drop, and they've been up for a year and a half, right? So this would have been April-ish, April, May of 2020, and we're in June of 2022. So it's been about actually 2 years. About 2 years they're up. And even after all this, the people that bought in down here are still up. So they're up only about 50% from where they were. They've lost a good chunk of that. It looks like about half that move has been recovered. So they're thinking to themselves, should I get out of this? Because a lot of these people are new. I mean, this stuff is what caused them to get in, and then the latecomers got in through the rest of this stuff. But the new people and the people that have been in for a while but took an opportunity while they could are thinking, I've lost half of my gains. Should I dump now or should I hold? And if it comes down to this point, am I going to continue to hold or am I going to sell? So I've talked to a few different friends that all have different philosophies. One of my friends says he wants to sell if it comes down to where he bought in, which I'm assuming is somewhere in this area. I really don't know for sure. One of my other friends says he's basically going to be diamond hands, but he was thinking about selling, which I think that's a better idea. If you're going to sell, unless, I mean, some stocks you still could sell if you wanted to, but if you're going to sell, the time to do it would have been probably in this mess right here. And honestly, with what may happen, you might still have a little bit of time to sell if we end up having a full-blown panic, which it looks like it may have already started without people knowing. Because, you look on the chart, this looks like this panic was extreme, but there was a week that it didn't really move. That would have been this little tiny candle right here. That week was going up for most part. It ended up going down towards the end, I think, a little bit, but it was essentially flat because we had this huge move the week before, and people thought, "Is this real? Is this the chance to get in?" Dip buyers were coming in, and then it got crushed even more. So you never know if it's done, because we kind of had like that little Friday cool off. But in my opinion, I think regardless of what happens next week, I think we still have some downturns. I have mostly gotten my positions to a point that I'm happy, but I still feel like I could trim a little more. I'm getting to the point where it's hard to trim things. I don't want to trim my really good long-term stocks and my safety stocks, like my dividend stocks, because most of them really aren't down very much at all. Dividend stocks are more of a safe haven, so a lot of people will sell the growth and the riskier assets to move into dividend stocks when times are rough like this. Some people move into bonds. Usually, you only move into bonds if you have a lot of money, or you move some of your money into bonds and you change some of your growth securities into dividend or safety stocks. I mean, stuff like Clorox and Coca-Cola and all that. Those are going to be things that aren't going to go down as much. For me, like Verizon is one of my safety stocks. It moves a little bit. Like when the pandemic happened, it dropped like $10 or something, 10, $15. It wasn't very much compared to a lot. You look at some other stocks, they were down. There were stocks that were like $80 that were down in the single digits and stuff. So those were the riskier ones though. Those were the growth stocks or the specs, which those are going to get crushed. Like that's what's going on right now. People that bought a bunch of specs in this and held are getting destroyed. Like if you bought a bunch of Nasdaq specs, you're in pain right now. Which is why I sold a bunch of that stuff off already, and I kind of this pop was a chance for me to sell a good chunk of what I wanted to trim down, and then as things came down, I sold a little more. I think on this pop here, I basically wait for opportunities to sell if I need to. And right now, anytime we get a rally until inflation comes down and until the Fed calms down, we're probably going to get crushed. So, you got to make your own decision when you're trading. I can't make any decisions for you. I'm not a financial advisor. I'm not giving anybody financial advice. I'm just telling you my own opinion and showing you how I do things. So hopefully you can learn from it and make your own decisions. But I've mostly been trimming and waiting on the sidelines because I was worried about this. See, when this started happening at the beginning of the year, and it was right at the beginning of the year, you could see that the last candle was the last week of last year. I mean, the last up candle was the last week of last year. And then every week since then has basically been in a trend, minus this little green mess right here, downward. And that was to be expected because the Fed came in around November, I think. So see, when we had this nice big green pop right here, and then we had a lot of uncertainty basically until it flipped around. This was where the Fed was saying, "Hey, we're going to start raising rates." This whole time they were being cheeky about, quote, the talk, right? They didn't want to have the talk about rates because they're thinking during that time eventually they're going to have to stamp this down, because that's what everybody knows that's been in the market for a while. When things go crazy in the market, the worry is inflation. How bad is inflation while the market is going up? Because the market is a sign that things are getting out of control. When people start to speculate like mad, then that means they have too much money to be speculating like that. If money is tight, people are not going to be throwing cash into these random startups that don't have any product and barely have a vision. If they are saving their money, prices are going to start to come down. So people expect that when inflation happens, the Fed is going to want to tamp things down. So they were waiting for the Fed to say, "Hey, we're going to start raising rates." But the Fed didn't say anything. They were saying we're going to have the talk. And in fact, they were being even cheekier than that. They were saying we have to have the talk about the talk. So through this mess in 2021, we were hearing the talk about the talk. So at some point in here, they had, quote, the talk about the talk. And then they had the actual talk somewhere over here. And that told me, all right, this is a different environment, because since this point right here, when in 2018, when this candle happened, the Fed decided to drop rates. And let's see, what is that? 10, 12, 17. Look, middle of the month. At the This week was one of the main reasons why the Fed decided to lower rates after raising them for like 4 straight years. I think 2014 or so, 2014, 2015 is when they started raising rates. And then they were doing it slowly, like a quarter point a meeting, and it was only a couple of meetings a year. By the time we got to here, we were at about 2.5%. I don't remember the specific amount, but somewhere in the twos, which is what was kind of causing a lot of this. I think this might have actually been when they did that, somewhere over here in September. I'm not sure, but basically, once the market went down, everybody was saying, "Oh no, Powell messed up, the Fed messed up," and they decided to cut rates from 2.5 to like 1.5, 1.25, something like that. They basically cut the rates in half, and then the market rallied, and that rally lasted until the pandemic. Even though there was volatility here, because there were a lot of things going on in 2019, mostly trade war stuff, and then we had the repo market fiasco right around here. That's, in my opinion, what caused these green candles. A bunch of money was able to enter the system cheaply through the repo markets, and what do you know? Prices went up right after that. So there was a lot of cash because some banks were in trouble, and the reason that this happened is because somebody didn't want to loan. The market didn't want to loan to some individual, some organization. There was somebody that they didn't feel was solvent enough to cover their loan, so the rates skyrocketed overnight. They went, up to like 10, 15%, whatever it was. Basically, repos are usually overnight loans or very quick loans, and it's a way for banks to capitalize real quick to cover some of their needs. A lot of times they need some cash at the end of the day, so they'll say, "All right, why don't you hold some of these stocks or whatever security and give me some cash so that I can make things work, and then I'll buy it back the next day at a little bit of an increase, so that way the lender makes money and the person borrowing can fix whatever they need to fix with that money." So that happened in here, and a bunch of new cash went into the system because of that. And of course, people were like, "Oh, the Fed's backing everything, so now we can be happy again." So part of this was probably because there were some entities that weren't looking good, some very important entities, most likely. I don't remember everything that was going on, so there's definitely more than that. But the repo market thing did tell me that there was a problem, and that just doesn't happen suddenly. It's something that has to happen for a while, because these entities usually have friends that will loan to them. even when they're not looking as good as they normally would. So it usually takes a little time before something extreme like that rate jump happens. But anyway, let's get to where we are right here with the with predictions. So my prediction is that we're probably going to keep going down. I think we have a bounce coming up at some point, whether it's next week or even if it's just a couple of days during the week or the week after. We've had so much downward movement. We've had these two really strong weeks. So let me zoom in a little bit so we can get a better picture of that. We've had these two really strong weeks, and there's been a lot of movement below the 100 moving average, below the median of the standard deviation channels on the 1 week, and there's a gap. So when you have that much movement, there's usually some resistance. Like think about anything. If you were to, push down, like punch water or something, slap the surface of water, there's resistance, and eventually you hit a point where your arm is done going down and it comes back up. You let it float, right? That's kind of the same thing. It's like we threw something in the water that is buoyant, but we threw it with enough force that it's going lower than it would before it bounces. So I'm thinking at some point we're going to have a bounce. When that's going to be, I don't know. It could be next week because we've already had this big move. And that analogy I gave was actually kind of terrible. I'll have to think of a better analogy than that. But I think about water. Like I think about things moving through a fluid when I look at a chart. I think of it as kind of an entity like that. I guess that would be the technical analysis part. Uh, just considering that this isn't just price action. This is how our society functions. This is what we're actually doing. So this is like a response to everything that's going on. You can see history in the charts. Like any big event, if you look at the charts, you can see a reaction to that event. You can see the volatility. So right now we've just had this huge move, and we're going to have a bounce at some time. But when that is, I really don't know. I would like to see a little bit lower if I could, but I don't think I can when I'm that zoomed in. So I'm going to have to zoom out just a little bit. There we go. That's what I'm looking for. All right. So my prediction is we're going to go probably, if we continue to go lower, which I think is the more likely path, we're going to break this little section right here that has super thin volume. And then we're going to come up to the half standard dev, so there might be a little resistance there. There's also the 200 week moving average. There might be a little resistance there. Let me switch to the daily chart and see what we have going on, because those are going to be different averages. And these would be more common. I think most people are going to be looking at the daily charts more so than the other charts. So let me zoom in a little bit more here. Get that. And it's difficult to use this with the volume profile because it always messes with me. All right, so if I move back a little more, I still don't see lower than that, which is too bad because that's what I need. I want to see a little bit lower. This is rough. I guess I'm not really going to get that. So we have punched below most of the moving averages. I'm looking for the 200-day moving average, which is not on there, and it's hard to see. Where are you? There you are. Okay, so it looks like we have punched through the 200-day moving average. That was the first one. Okay, because it's not going down as much. Well, that would make sense. My bad. Yeah, we went right through that already. We're through all of the main averages. We're through one standard deviation. We're about halfway to half a standard deviation. So on the daily, it looks like the next spot really is right here where the volume starts to pick up at the half standard deviation mark. And if you look over here, this is where there was a significant amount of volatility the first time we passed that. And why was that? Because we were hitting a previous high. This high right before the pandemic was the top. And if you look at any stock when it comes up to a previous high, there's usually some volatility there because that's when people have their sell orders in. People that were all buying in below this, waiting for this opportunity, are getting ready to get out. I mean, that's why you see this big green squeeze right here, is because a bunch of people get out, it doesn't drop, they want to get back in. The shorts who thought it was going to drop have to buy to cover, everything takes off. And when it comes back down, it's moving around and goes under it, comes back up. So it's the same thing. I mean, you can see this is a really volatile time. This is also in September when volatility picks up anyway. So this is a really good spot to see support start to come back in. And that's what we're going to see right here. Is this little area of volume is going to be picking up. And as it goes down, we're going to have a little bit more strength. The actual decent support comes in somewhere around this 289, or actually the 300. So 3,000 on the actual SPX is about where the bigger support starts to come in. But we have extremely thin volume for the next, let's see, where are we at right now? We're at about 365. We have very thin volume to 341. So we're going to lose about 200 points on the SPX before things start to bounce a little bit. So that's kind of what I'm thinking. I don't think it's going to be straight down there. I think it's going to be very volatile. Right now, there's some optimism, that I think is a little overrated. So I think if we have a rally, which I'm actually part of me is kind of hoping we do, so that I can maybe trim a little more if I want to. And also, a rally would be a way to get some of these hands out of the market that are either selling their positions or the bulls that are going to get trapped, because there are going to be a lot of people that get trapped on a bounce. A lot of people think that this is going up right away, and it actually might go up soon. That's why I'm not too worried either way, because I have my long portfolio that'll benefit if it goes up. I have a lot of my cash on the sidelines if it goes down, and I have some shorts on things that will benefit if it goes down. And these shorts are not very big, so if they end up coming up, it's not going to hurt me if things go up. Hey, Future Space G, what's going on? Waiting for capitulation, stack some money for when Tesla hits 400. Well, actually, I started buying again, so I had that nice little trade on Tesla. In fact, let's take a look at Tesla now that you're here. TSLA. I bought it on this last little. Here, let me turn the things off real quick. If I go to style settings, go to price or time axis, show rollovers, show Friday. I don't want any of that. Okay. So Tesla, when it came down here, the first time it was in the low 600s. I ended up buying a little bit of it down here, and I think like a day or two late, yeah, I was buying it. I think on this red day right here, actually, either that or this green day. But within a couple of days, it bounced up here, so I sold into this mess because I thought, oh, that's a really nice game. Not to mention it was bouncing off one of the moving averages, and it kind of came over the one standard deviation line. But yeah, then when it came back down, a couple of days ago, I started buying in here. So it's one of these candles, I believe, is where I was buying in. So what do you got? You have 480 to 300. No one believed me. Keep money for when Tesla and Apple capitulate. Those are the last to fall. They might be. Apple's such a it's such a loved stock that it's going to be the last one to really fall down. I mean, it's going to move with the market a little bit, but because it is such a good stock, and it's kind of a safety stock, even though it's also still technically kind of a growth stock too. People will move to it. Tesla is kind of the same way, but it's not as strong. It's not as established. It has higher volatility, so it could hit harder. So it says, so you're saying those are the last to fall. Don't rush to buy yet. You can buy smaller stocks. Yeah, that's kind of why I bought a tiny little amount. I'm hoping it keeps going so that I can add some more to my position, because I made that little trade on it, and I kind of wish I made the trade on Amazon too, because now my Amazon position is below where I got in. So I was up. I had a nice little profit on it initially and didn't take my gains, but that's okay because I want to hold that long term. Same with Tesla. So let's see. You can buy smaller stocks, those that have fallen from $10 to 2, for example. Those are fine. Yeah, and a lot of those are going to be the speculative stocks anyway that were overinflated during the bull market, or they're newer stocks or lesser known stocks. So those are good ones to find. But if they're specs that were shady in the first place, I don't know. But they're definitely going to get crushed even more if things continue to go down. So we see Oatly, SDC, etc. Yeah, see those are new. Are those newer stocks? Like what is SDC? I'm not familiar with that one. Let's take a look real quick. Um, Smile Direct. Oh, okay, yeah. Smile Direct. You like it? You like it? Smile Direct, Future Space G. What's wrong with you? What's wrong with you? No, it's actually another competitor to Invisalign and stuff like that. They just never looked good from the start because of this whole drop. But where are they now? They're pretty low. They're below their mean price here. So basically, everybody's underwater that owns Smile Direct Club. Let's see. Used an example. You don't have it. Okay, good. I was gonna lose some respect for you if you had that. It's like this guy knows better than to have Smile Direct Club, but no, you're good. You're out of it. But if you look at it, I like what you're saying about the picking it up at a low price, because this right here is the point of control. This is where most people bought in and have shares, and we're at a very thin volume low that has never been touched before. Look, it's at under $1 right now. Yeah, I wouldn't touch this thing, man. Like you could, it might jump, but as long as the market keeps going down, this thing probably isn't going to pop unless they put some news out, which I wouldn't put it past them. They companies that are here's an example. Is this a NASDAQ stock? Okay, so here's one thing you know for sure. With a NASDAQ stock, they have requirements to stay above $1, otherwise they get delisted. So right now, Smile Direct Club is technically below $1, so they have 30 days to get their price above $1 and hold it there for a certain amount of time in order to stay listed. If they don't, they're going to get a letter from the NASDAQ that's going to give them another like 30 or 60 days to get their price in order. And if they don't, then they get delisted and they have to go to the over-the-counter market, which, I don't know. So stuff like this, I wouldn't. I mean, I'm not going to buy that anyway. I know you're just using it as an example, but these ones are. I don't think a lot of these ones are done yet. I mean, the ones that have gone down quite a bit are the candidates to get crushed the most in a panic, because you have to think about what people's portfolios look like. And if somebody's holding this, if somebody bought into this, let's say above the point of control, because most likely you're going to get in above that. So somebody probably saw it coming down and they looked at it at like $8, set $5, stuff like that. Thought, oh, this is great. This has come down from whatever to 5. They're underwater now, and they're looking at their other positions, going, I'm underwater on those too. So what do I get rid of? Well, if you're smart, you get rid of the penny stock that you lost a bunch of money on. You keep the good ones, or maybe the medium ones. Honestly, in my opinion, I think you should trim the crappy and the medium ones and just keep your good ones when stuff like this happens. But everyone has their own idea. So maybe if you don't get rid of the medium ones, whatever, but you definitely want to get rid of the ones that perform the least. The other thing, though, is the fact that it's been crushed. At some point in the future, this might be a decent trade. I don't know, though. I have to look at their financials and their fundamentals. So let's see what you got down here. It's a company, let's see, Kraft Heinz. Auto buy at 25. Company older than us, worldwide. Food will never die. Yeah, I 100% agree with that. Kraft Heinz. Actually, that's a safety stock. What is the ticker symbol for that? I'll get that. FT Kraft Heinz KHC. Let's take a look at KHC. See, that one I like a lot more. It's come down, and actually, it had some serious problems. This gap down right here was this. So this is actually. I'm thinking late. Let me turn this back to the weekly charts because it's kind of messing with me having the daily on there. Okay. Um, is this? Did they did they relist? Yeah, they relisted at some point. I think that they were private and they came back or something. That's why there's only so much history. It only goes back to, let's see, 20th, 18, 16. So not that far. Yeah, it really doesn't go that far. But it has been beat up. It's right by this little point of control. I mean, that might be something to look into. I'm not going to get it. It's not my kind of thing. I don't like this chart, actually. Like, I do like the fact that they're beat up and they're a company that isn't going away. And you're right, food is always going to be necessary, especially packaged food, because that can last. And in a crisis like right now, we're going to have food shortages. Right now, we're having price increases and inflation, and the shortages are sort of coming in, but we haven't really hit the big part of the shortages. Like, there's still inventories that need to be cleared out in a lot of sectors. And once those are cleared out, getting new inventory in is going to be tough because there's still issue with shipping. Shipping's all over the place right now. So packaged foods are going to be extremely important. Things are going to be stuck in ports. Things are going to be traveling a lot. So companies like Kraft Heinz and Mondelez and all those are going to have an edge in that sense. That this company specifically, I don't know. I don't follow them enough to really know anything about them. Let's see what else we got here. Let's see, Tesla at 400. I may think about it for 10 shares, especially if they split. Yeah, they are going to split. They filed for it. So the question is when. Um, I 400 would be a great price, and I just bought a tiny little bit, so I'm not really expecting it to pop or to go up in the short term. I do think that it'll drop lower. 400 would be great. Let's see, where is 400? So let me zoom in a little bit so we can get a better picture of the thing. They're running ad breaks on your stream today, big time. Yeah. No, it gave me this option. It was like, all right, you get to pick where the ads go and how long they are. And it was like, all right, well, what's the shortest amount of time I can possibly do? And it's supposed to warn me. I put a thing in that says warn me when you go to ad break, but I apologize if you're getting ads. I don't know if they're playing right now or if they've stopped, but I can't really do anything about that. It basically says, here you go, here are the ads. They're going to play, but where do you want to play them? So I tried to shrink them down as much as possible, but they're going to be in there a little bit. So I apologize for that. There should be 2 ad breaks an hour. There's usually one when you first click onto something and then some after that. Let's see. So what do you got here? Since we see S&P 300 or lower, Tesla will break this 600 support. Next, approximately 400. We'll definitely get there. Oh, I love those. I love those absolute predictions coming from Future Space G. This guy knows what he's talking about here. So far, both you and I have been quite right on a lot of this stuff. It's kind of funny. It seems like every week there's somebody that comes into the stream and wants to tell us that we're going to the moon and stuff like that. But every week I say I don't think that's going to happen. There's just aren't enough factors to tell us that it's going to happen. The market has not cleared up the inflation. There's still the war in Ukraine. There's still the Fed. There's still supply chain issues. So all that stuff has to come down. And really, the big one is oil. Like oil keeps going up, and that's putting a huge amount of pressure on the market. So you have to think about the price of oil versus everything else. And that's actually one of the main things that the Fed is looking at. They want oil prices down, and they're willing to crush the economy to get that. So in the short term, yeah, things are going to get crushed. Tesla, even though you think, oh, well, Tesla doesn't use oil. It's a green play and blah, blah, blah. Well, yeah, but it's still tied to everything else. It's still in the indexes. That's the bad part about being put in the indexes. You're going to be subject to moves that aren't your fault. But for us, traders and investors, that's a good thing because that lets us get into these. This drop in Tesla right now is the best thing that could have happened for us because I didn't get the uptrend in Tesla. I missed it. I mean, I made a few trades on it, but I didn't get anything real from the uptick in Tesla, and I could have. And I kick myself all the time thinking about it. So what do you got down here? Let's see. You've got zero ads on the stream. Good. Tesla has been pumped massively by hedges. Well, yeah. I mean, hedge funds are all about Tesla. The media, CNBC, everyone you can think of, they're pumping Tesla because so many people have made money off of it. That's why they pump it. Anything that you see pumped by hedge funds and big financial celebrities, it's because it's a big money maker. They're not pushing Tesla or Bitcoin because they believe in those things. They may believe in those things, but the reason they're pushing them is because they make the most money off those things. So they're going to give you the case. They're going to tell you why you should buy it because they're going to change the world and all that. But really, they're just thinking this is a good way to get money. And the more excited I get the retail trader, the better. So we got here. More sell off Tesla, please. Yes, 100%. Sharky Tori, I really want it to keep going down. I think it's going to because I think the market's going to keep going and there's just going to be some capitulation because of that. But my question is how far? So future space G is thinking next couple of months it's going down to 400 or lower. I think that's possible. If you look at this little area right here, this is the next area that actually has decent volume. So we have even less volume right here on Tesla than the SPY does. So you think about pretty much every stock is kind of in the same pattern. There's these three little bumps, right? There's the big support from where we had been for years before everything went crazy, because this right here was the 2020 pump and dump right here, right? So we had this would have been right when everything peaked before the pandemic, and then it bottomed down here and went insane from there. But before that hand, most of the trading happened here. That's why this point of control is so low. So most people got in when Tesla was trading at $50 or $60 or whatever. But when it moved so quickly that it had to have a correction, and you can see that's what happened right here. I don't remember when I drew this line. I drew this a long time ago, but look at how well that held up, actually. That's pretty funny. I probably put it in somewhere around this spot right here, and actually it's going along the moving average, so that makes sense. Yeah, Tesla's going to, so what do we got down here? Let's see. You guarantee you all Tesla 400 for sure. All right, I'm holding you to that, Future Space G. Next couple of months, I'm going to say, all right, let's see where Tesla is. Let's see where Future Space G's prediction is. Because you've been right so far. You had that short. I don't know if you took it off the table. I think did you say you took your short off the table when it bounced a couple of weeks ago? If you didn't, then man, your target has been hit or breached. It's the time. This has been wonderful for that short, I'm sure. I've got some shorts going on right now that are very small ones. Yeah, you exited. That's right. I thought you did. I know, too bad, but hey, you exited when you thought things were going to go wrong, and that's important. It's better to be safe when you're shorting, especially if you're shorting with margin or anything like that. I don't know if you were, because you were trading the oh god, I forgot the name. You're trading the difference contracts, whatever they were. I don't know if there's margin or anything involved in that, but it's better to be safe than sorry when you're shorting things, because stuff can get really, really out of hand quickly in those kind of situations. Now, let's see. You shorted since 1,000, same as Gates. You exited. You saw the money, got out. Use only S&P short now. Must realize hedge pump this hard. Hedge funds are pumping this hard. Yeah, they really are, especially with this split. And here's the interesting thing. All right, so speaking of splits, this is actually something I want to bring up. All right, what'd you say? It's used as an escape. Yeah, it is kind of used as an escape. Kind of, I think it's also somewhat of a hedge against things, even though it's moving down. People know that this is the time to get into this position because Tesla doesn't stay down for long. Once things turn around, Tesla's like the canary in the coal mine. It'll boom, start popping before everything else. But what I wanted to talk about here was something that I completely forgot about because I went and read comments and then don't remember exactly what I was going to say. But I wrote it somewhere in my notes here, and it has to do with okay, splits. All right, so this is the interesting thing that I wanted to bring up. So there's been talk about the Tesla split that's coming up, right? We had the split in Amazon already, which was, you could have made a little bit on that, and I chose not to take my profits. But we're thinking about splits now, especially Wall Street bets, and then the financial media on TV, on the internet. They're all kind of talking about that a little bit. But the interesting thing is, the last time Tesla split, which this little pink dot right here shows you the 5-for-1 split Tesla had in August of 2020. At that time, fractional shares hadn't quite swept through the market yet. So the reason that you would split is so that you can allow investors with less money to get in, or investors that are wary about spending so much a chance to get into your stock as well. So although it doesn't add value, it does add a customer base. Basically, it allows a broader range of people to be able to get in. And before we had fractional shares, that was kind of the only thing you could do. So Tesla was very smart. They did their 5-for-1 split when they were hot. Their price went up to a ridiculous amount. It was like 2,000 something. I think when it split, it was around 2,400 maybe. I don't know. I remember selling puts at 21, thinking this is gonna, or below 21, thinking like, okay, 21, 22 is about where I was expecting it to be before the split. But it was above that, so that was nice. But there wasn't fractional share trading at that point. So that was more important. Now there is. Basically, it started coming in a little bit after that. So you could just buy a chunk of Amazon. You could just buy a chunk of whatever you want through brokers like Robinhood. And not everybody's doing it, but a lot of brokers are now because they have to compete. So this split is not exactly in the same vein as this split was. So the question is it going to pump as much? I don't think it's going to pump quite as much, but I still think that there's going to be a pump around it. And what we really want to see is market conditions lining up with that split. Because all right, I'm going to give you like the main piece of information that you ever need in trading, and it's extremely obvious. You probably already know it. The market direction affects everything you're doing. So it doesn't matter if you're right about a trade. It doesn't matter if you're right that some company had this. It doesn't matter if your position was perfectly positioned for whatever the move is. If the market doesn't confirm that move, it's not going to work out for you, especially if you're trading options. So you always want the market to be in your favor. If you're expecting to trade on an up, you want a stock to be up. You want to make sure you want the market to be up on that same day, because that's either going to allow the move to happen overall or increase that move. Because sometimes you'll get a pop when in a specific stock when a market's going down, but that's usually when there's really good news or the stock has some reason for staying up like that. But most of the time, you're going to get the tide moving things around along with your move. So what we want is we want the market to be up on the day that the split actually happens, the day that the split goes live. And a lot of times these things take place on a Monday. So they'll say Friday night you is the last time you have to get in or out of your position before the split happens, and then the Monday that it opens, or the Tuesday, depending upon the week, if Monday's a closed day like this week, um, uh, then the split will take effect, and that's when the reaction to it will happen. I like to be in before that moment because there are people that'll wait till after, but if you're in beforehand, then any upward movement you have is good for you. Whereas if you're trying to trade the move, you might be getting in intraday or trying to get this candle, that candle, whatever. So make sure if you're going to trade something, it goes along with the market. So if you're going to trade a split, the best way you can do that is look for a nice red day before the split happens. Start your position, get it going on the absolute lows that you can possibly buy on, and sell into the pop that comes from the split if you play the split at all. I don't know if I'm going to, because this market condition is not what I want to be dancing around in with little trades like this, because it's very uncertain. Now, if any stock is going to pop on a split, it's Tesla. Tesla has the most volatility. It has the most eyeballs on it. So when the split happens at some point, which I'm expecting in the next few months, uh, we want the market to be going up on that day if we're going to play it. And I want to keep Tesla long term, so I don't think I'm actually going to play the split. I think I'm going to try to get in before the split and then just write it and add to my position in a dollar cost average style like I normally would. Because Amazon and Tesla were two of my stocks that I really wanted to get. The other one is Apple. I really want to get Apple one day. So this downtick is a chance for me to actually get into this. I had some growth stocks that I sold. Ended up making a good amount of money on a grocery outlet, for example. That was one that I was buying in the low to mid 20s, and I sold it in the high 30s. So that was wonderful. I took a bunch of that cash off the table before the Fed meeting, because it was staying up even while other stocks were dropping. It was holding a nice level, which was great. And then having that trade go so well. So Future Space G, I don't know if you were on the stream earlier, and I'm guessing you didn't catch the stream from Wednesday when the Fed meeting happened. But I ended up making a trade on the QQQ, and I was up $200 or more than $200. It was almost 50% in 12 minutes. I took my gains right away. I bought some QQQ calls right at the bottom when Jerome Powell was talking, and 12 minutes later I dumped them for a nice almost 50% profit on each call. So that was beautiful. So that's some extra cash that I have sitting around there too. So I'm hoping to put some of that into Tesla. I bought a little bit of crypto because crypto is getting crushed. Right now I don't even know what it's at, but it was around 20K when everything was closing on Friday, maybe like 21, 22. It's been getting hammered crazily. So we're looking at some serious volatility coming up. And this split in Tesla is going to be an interesting event, whether it pops or not. Even if the market's not doing well, I do think there will be some sort of a reaction to Tesla just because it's Tesla. So I'm keeping an eye on that, and that's something that I really want to take a look at. So let's see what other stock news we have going on here. Actually, I have Tesla on the list. So one of the things they did here is they raised prices on the Model Y, which is a good thing for investors because that's more potential for profit. But at the same time, what that's really doing is covering the cost of inflation. So this is going to be a wash. What you would normally see as a drop because they're not doing anything is now sideways action because they're covering what they would have lost. Let's see. What does the other thing say here for Tesla? Let's see. 70. Oh, and here's something that's bad for Tesla. There's been for a couple of years now. There's always little articles that come up about Tesla autopilot crashes. What is he? BB Shots, dude. I love futures. Yeah, futures is the way to go, but they're closed right now because the market's closed tomorrow. So unfortunately, we don't get to see what's going on. Normally, every week I open with the futures and just take a look so that we can get an idea of what's going on the next week. I don't actually trade futures, but I watch them because the futures market will dictate what's going on. In fact, if you look at the VIX is based on S&P future options. So it's a good way to it's a good way to gauge the health of the market. It's not everything, but it's where a lot of the bigger money lies. So I like to see where that goes before I check the retail market. So what do you got here? I do crypto futures. Thoughts? Oh, crypto futures. So I haven't looked too much into crypto futures, but I like the idea because I like the ability to be able to short crypto or go long because it's so volatile and you can make so much money going both directions. I really want to get into that more, so I wish I had more for you on that one. But I do like the idea of crypto futures, and I think that is a great place to make money. Do you have any positions open right now in crypto futures? See, I don't like the idea of spots for crypto, but I do love futures for crypto. Well, I mean that's part of it. You can't have one without the other. You're gonna have the spot price. You're gonna have the deterioration oh my god, I'm drawing a blank on the name. The curve, whether it's in contango or not. It's been a while since I was looking at all that. But with crypto, you have that ability to make so much money that I think the futures are actually a really good idea, especially if you believe in them long term, because right now they're getting crushed. So if you wanted to get longer contracts way out there, this would be a good time to do it. And as it falls even more, it'd be an even better time to do it. I'm actually just buying crypto itself. I'm not going into any of the other options like no derivatives or anything. You quadrupled your port in futures for Bitcoin today. No current open orders for me tonight. Just closed on a huge trade. Hey, good for you. I had a good trade earlier this week too. I ended up trading the Qs during Jerome Powell's speech. That's good. This was a nice money making week for a lot of people. I'm glad to hear that people are doing well.
Let's see what you got over here. Crypto futures suck, huh? Future space, you not into them? Wait their production and sales for winter. Let's see. Plus CFD is better than futures. Oh yeah, CFDs. That was right. I was doing a little research on CFDs. You know what's funny? CFDs are legal everywhere but America and Brazil, so I can't touch them, unfortunately. And I like the way the contract for difference looks like such a good way to trade compared to doing some of this other stuff. I like options because of my account size. It's the easiest for me to make money, and now that I've been doing it long enough, I got a feel for how they move. But contract for difference is such a nice way to trade. I wish they had them in America. Let's see. Might do a quick BTC short. It's going down and just got rejected. Are you day trading these? Or are you because I'm not as good with day trades. I usually like to swing trade or invest long term. I got lucky with that day trade during Powell's speech just because I was expecting it to happen and it looked like a high odds trade to me. You day trade. Okay, so you're very chart driven. I'm a little bit chart driven. I like technical analysis, but I only let it go so far because you have to have a different mind to day trade. You have to be much more in tune with your emotions and able to control that. And as trading for a while, I've been able to get a hang of that a little bit, but I don't have the stomach to sit there and watch my stuff just minute after minute. That because I did that when I first started and it was brutal. I found the easiest way for me is to do a swing trade, go on price levels that I like, support levels derived from volume, from fundamentals, and that way I could sleep a little better at night and get something that I don't have to trade right away. Like I like leap options. That's basically what I trade, are leaps, because that for me works the best. It allows me to maximize the amount of money in my account and go farther with it, usually within like a couple of weeks, because a lot of the trades I make are like 2-3 week trades. And what's funny though is a lot of them end up being a few days because I expect a move to happen later than it does, but it happens early, which is fine with me because I want to get out. Let's see. Yeah, you respect that. Yeah, there are so many different ways to trade, and I'm actually glad that somebody like you is in here because you have some insight that I would like to know about. Because day trading for me is so difficult. I tried day trading penny stocks when I first started, and it was like the hardest thing I've ever tried. It was so brutal, and I don't like penny stocks because a lot of them are scams. You can't always get all the information, especially if they're OTC stocks. And I want to see the financials. Like I need to see your financials if I'm going to trade you. That's just a rule that I have. Let's see. It's hard to day trade because you can't start to gamble. Yes, people will get into gambling so quickly when they're day trading. That's the other thing I don't like about it. I want to have some sense of surety that my move is going to happen. I want to have confidence in the direction of the move, and I also want to have time so that way if it goes down, I'm not just stuck there. So scalping is not an easy thing for me to do. Let's see. Instead of trading intelligent, they gamble. Yeah, definitely. Day trade is a mess. It wrecks you mentally. Takes so much time, so much risk. Yeah, I remember day trading just feeling sick all the time, like feeling sick to my stomach because I was holding 2/3 of my entire cash pile in some stupid penny stock that I had no idea was even the company that I thought it was. It could have been just a shell or a sham, and I'm sitting there with most of my money in it overnight or something. It's just, oh, it's brutal. I hate that. I absolutely hate that. See, but if you trade smart based on technical analysis, you can make a ton. Day trading is a scam. It can be a scam. Technical analysis, though, it's in my opinion, I mean, you use it for day trading and obviously it's working for you, but in my opinion, technical analysis is only one piece of the equation. It's just a way to kind of gauge that you're going in the right direction. I like the fundamentals as the foundation for everything. I like the news that comes out as the secondary peak, and then on top of that, technical analysis. So I put technical analysis in like the third tier of everything, because it doesn't always work out the way you think it does. The patterns, you might see a pattern forming, but in the moment, it's so hard to actually tell. So you're doing like, let's see, your trades last for about 45 minutes max, usually around 15. Like you expect 45, but they end up with 15 or so. Yeah, that's kind of how I like those trades. It's really nice to not have to feel sick to your stomach for a little while. You can get out early. That's great. Let's see. I try to avoid short time positions. Yeah, me too. The only thing that worked for me is like the last two Fed meetings. I day traded because it's every Fed meeting that I've seen has the same pattern. And I know we talked about this earlier, but none of you were in here, so I'm going to pull this up one more time. Let's go to the Qs real quick. There it is. There's the Fed meeting. So the trade that I ended up making was right here is where the rates come out. So the first candle, it gets really volatile, and I don't touch that because that's usually just the algos going, and it's rates that we pretty much knew were going to happen. Like people were expecting a 75 basis point hike at this point. So when they came out with 75, I thought, okay, that's in line. The algos are doing their thing. They're driving up volatility. Look at this volume candle. If I bring that up a little bit, you can see this was huge. This was like over 3.5 million shares traded on the Qs right there. But then it kind of came to this part and it sat there. It rested. It went to this point, and if it went above it or below it, it always came back to this 278 level. This was telling me that there was some support there. Yeah, but the fact that it didn't continue to trend down, that it stayed basically perfectly at this level right here for 5, 10, 15, 20, 25, 30 minutes, it was sitting right there. And then when it went down a little lower below the lowest candle, came right back up. This was like, it spent maybe 30 seconds or a minute down here before it bounced on strong volume. So that told me that there is support here. There are buyers willing to come in. So I ended up getting long the 292 strike, QQQ January or July 15th calls right about here. And then 12 minutes later, they were up $200 a pop. And as it started to get some resistance right here, I ended up selling into this candle, making almost 50% gain. And of course, it went down for a while. It did come back, but this pattern right here was all that I was waiting for, right? Usually there's the numbers come out, the first candle is wild, then it kind of settles down. Jerome Powell starts talking right about here at 11:30 and things tank. But once they tank, they hit a bottom and they bounce. And this is normally the pattern for the Fed. This S-shaped kind of thing right here, like up, down, up. That is almost every Fed meeting I've seen has that exact same pattern in one way or another. So I thought because it wasn't going down anymore, this would be a good chance to get into a day trade. This was all technicals. Also the fundamentals, because 75 basis point was the hike. I knew that was in line with market expectations, and the market liked it, which is why it wasn't going down. So mixing technical analysis and fundamentals was the reason I got into this day trade. I need the backing of more than just one thing. I don't like fundamentals alone. I don't like technical analysis alone, and I don't like just a catalyst from the news alone. I like to have all three if possible, and that's what I got with this. So when I saw my gains, I just took them right away because the next day things started to go down, which I kind of expected to happen since that's what happened at the last meeting. So let's see what we got over here. I missed a few of your chat things here. With futures, you need high leverage, low percentage of your portfolio, or high percentage of your portfolio, low leverage. See, that's the other thing. I don't like using leverage. I don't use any. I don't want to get a margin call. I want to make sure that no matter what happens, it's my own money and I can keep my securities. So yeah, that's the one thing that I don't like about futures is you basically need margin to do it, or you need a ton of cash, which I don't have margin, so I'm not going to touch that right now. Let's see. Future Space G. I think the S&P goes to 3,000 and I shorted at 4,100. I ain't getting out of this position at 3,600 for profit. I keep it long trade, no short trade. Or not short trade. Yeah, okay, so you do still have a little bit. That's good. That's good. Let's see. Plus, you avoid the short squeezes that wreck day traders when you least expect. Yeah, that's the one thing that That's the other reason I don't like to day trade is because things can turn on a dime. I mean, think about up here. People were thinking that this was going to the moon. If you just saw these two candles and how quickly they went up, it was looking like, oh, this is going to keep going. So I guarantee you, this was a bull trap, and a bunch of people got crushed right in here. And if they probably didn't hold because they were short terms, and maybe they bought into this FOMO and got crushed again. So that's why I don't like uh, trading on that time frame because you don't usually get it. I was expecting this to be a little bit longer. I thought it was going to take longer for the calls to get up to this point, and I was kind of expecting since everything came in line with what we expected to be above the average for the day, which was somewhere around here. So once the calls were sitting in this area, I started thinking about selling just because I thought, all right, this is a good enough amount. We've got strong volume, things are still moving. But as the volume cut down and the candle started to have some problems, I knew, okay, this is time to get out. So that was one of my best day trades ever. I've never had that much success in that small amount of time. So that was wonderful. So where were we right here? We were getting to some of these different stocks. So yeah, that was the trade that I make, the only day trade. I don't do it very often, but during Fed meetings, if things look like they're good, yeah, that's a time that would be a good time to do it. If the Fed came out and said we're lowering interest rates, then I'd probably day trade the hell out of that because that's so bullish for the market. It's not going to happen, which is why I would jump into it if it really did happen. So where were we right here? basically we were looking at the fact that we have thin volume right here. There's a good chance that we drop down to the low 300s. We start seeing support when we get into this mess from the pandemic era. That's going to be around that just under 300 mark. So if things do trend, that's kind of the area that I'm looking for. I'm going to be buying stuff I like into all of this. I've been buying for a while now. I sold more up here with a lot of the stuff that I wanted to trim, and every week that I come in, I've been telling people, if you are not sure about positions, this is a good time to trim because it's probably going to get worse, and it did. I mean, it's been pretty bad for a lot of people, but for me, this is wonderful. I've been loving this market. I've been waiting for 2 years for this market. I mean, this I didn't know what to do in the 2021 bull market. I had never seen things go up that quickly, and I expected them to crash down. They never did. So I didn't make very many moves. It was very frustrating. Everybody else I knew was making all this money and they were super happy, and I was just kind of sitting there. So now that we're actually coming down, I've been doing so much better. This has been a way, way better year than last year. By this point last year, I was down, and this year, I'm way up. So that's wonderful. I'm very much happy with how it's gone. So what do we got? Future Space G 2800 seems to be the max bottom. Let me switch to the SPX so we can actually get the right number here. 2800 seems to be the bottom. Where is 2800? Right here. Yeah. Oh, see, look at that. You're picking this price that I like right here. So earlier I was talking about how support and resistance are kind of like gravity. They're kind of like magnets. They'll pull things toward them in either direction. And that's this section right here. If you put that 2800, in fact, I like that spot right there. Or maybe I like it right about here. Let's say 2900. Because if you look at 2900, there's like a gap here, a gap here. There's a bunch of volatility right here, which actually this is where I discovered options, and I made a whole bunch of money on this drop right. Actually, I discovered them over here, but these two drops were why I trade options because I was not doing well with stocks. And when I found out about options, I bought some puts like right before each of these drops happened, and I thought, okay, I think this is the field for me. Stocks didn't work so well, options are great. So we're gonna say 2900 is about that level that I like because it's right in the middle of this. There are gaps everywhere. There's a good amount of support. If we switch back to the SPY, because the SPX doesn't have any volume, that's why I like that. So that would be the 2900 on the SPY. You basically just take out a zero for this. Look at the volume. That's right here. That 2800 level that you were talking about is that top. So I'll go with that for what you were saying. 2800 for the high volume mark right here. So this is where big support comes in. But if you look at it, it picks up as we go down. So I can see this getting broken so easily, and it starts to get a little heavier right here, and you can see how volatile it was over at this side. The high before the pandemic is a big one, and I think that's why volume picks up right there. So I think if we drop here, I think we'll have a little bit of capitulation here until we either go farther or come back. The Fed is talking about a more severe rate hike next time too. So this is why. All right, let me pull up my little chart real quick. So this is why I think things are going to continue to go down because I've been following what the Fed's been saying. Because right now the Fed is everything, right? There's inflation, there's supply chain issues, there's shipping issues. Yes, but the Fed is the big thing. So this is the graph that I made. What do you say here? But I think inflation will recover in short months. Yeah, that's what I wanted to talk about. The Fed is picking up its pace because they want to crush inflation quicker. So these people that are saying that it's going to be the recession's coming, and oh no, yeah, I'm sure a recession's coming. A recession just means 2 quarters where GDP does not grow as much. So negative GDP. That means GDP could still technically grow, just not as much. It'd just be like a negative number from what it was before, right? Because they measure these to the month and the year before to get a comparison. So yeah, recession's probably going to happen. We're probably going to have a lower GDP number this time, considering we've already had revisions by the Fed and other organizations. So let's see, right here. So the Fed dot plot shows rates at about 3% at the end of the year, which is kind of what is in line, 3 to 3.5%. Let's see, the projected unemployment's around 3.7. Okay, here we go. The projected GDP was 2.8, and they downgraded it to 1.7. And if that ends up happening, then it's probably because we're going to have a bad quarter this quarter. and possibly next quarter. But we'll have to see what that is. So I'm quite sure that a recession, or I'm not gonna say I'm sure, but I think it's more likely than not that we're already in a recession, and it's the next GDP number is going to tell us that. We have to wait another, I want to say, a month or so. I think the GDP comes out towards the beginning of the month, so actually about two or 3 weeks, and we should have some more. Let's see. You're in the middle of a short right now. Don't trade BTC, my man. You'll get burned. Well, you can trade Bitcoin. It just depends upon what you're doing. I mean, if you're going long, you're probably going to get burned. But if you're a long-term investor, it's a great time to buy. But if you're shorting, which I'm assuming BB Shots is able to do, then you can go either direction and actually make a good amount of money. It's risky. I am going to agree with you on that 100%. It's extremely risky. So if you have the stomach and the cash for it, that's fine. But if you don't, then it's probably not something you should do. However, if you're into crypto futures, then I would assume that you have at least enough knowledge and constitution to be able to do that. So what do we got here? They can catch you like a fly. It's very, very, very risky. 100% it is. But you know what? You can make a ton of money. That's where there's risk, there's reward. The higher the risk, the higher the reward. All right. So back to my graph here. The reason I wanted to bring this up is because originally we had the June and July meetings as possible 50s. Now we've got a lot of these people saying between 50 and 75, which is why I have the 50 plus right here. And we've got an earnings season coming up. It starts late July, which is why I kind of added that right there. So we're going to have the Fed right in the middle, and then right after that, there's basically going to be the start of earnings season, and that'll go, through most of August too. And actually, you basically have earnings all month, but the bulk of them happen towards the middle of the quarter. So we're going to have, a Fed rate change, possibly 50, but maybe more like 75. Even though Jerome Powell said it's probably not going to be that, 75 is not the norm. I still think there's a good chance that this next one is 75, and we'll have to see how it feels going into that. Um, but we're going to have that. Then we're going to have earnings season. So huge volatility. And earnings season is going to tell us what we need to know for the next meeting and for the rest of the year on the market. People are going to be reacting to how well these companies are doing. And I don't think they're going to do well. I think it's going to be just like this earnings season. The shipping problem hasn't cleared up, and shipping is what killed so many companies. You think about Target, right? Target crashed. I don't know if any of you saw Target a few weeks, a month ago, whenever it was, but it got cut hard. And it was funny because Walmart reported the day before and they crashed the whole sector. So Target already dropped because Walmart didn't do as well. And I knew on that day that Target was going to get destroyed. I thought this is a chance for a move. I didn't end up trading because I was distracted. I have a kid and the kid was all in my face. And I had a bunch of stuff to do, and it's just I couldn't concentrate. And I thought, you know what, screw it. It's already dropped. I don't know if I'm going to have as good of a chance to get in on that. But oh man, I could have bought even a little thing on that, and it would have been so profitable. Some of these like 20, 30, $40 contracts that were weeklies, which I don't like to buy, ended up being well over $1,000 the next day. So I mean, I could have literally just thrown 20 bucks into something and come up with $1,000 the next day. That would have been amazing. But anyway, the reason they went down, the whole reason I brought this up is because they had too much inventory, right? They're very heavily into clothing and seasonal decor and stuff like that, stuff that has to move off the shelves quickly. Like fashion, for example, changes constantly. It doesn't have to, but that's how the industry makes money. They have to keep telling you that the things from 6 months ago and a year ago aren't cool anymore. So now you got to buy the new stupid thing. Like, oh, look at this. We put holes in the jeans now. Oh, the holes aren't cool anymore. So now we put these little lines on them. Oh, the lines aren't cool anymore. So now we're doing boot cut. Now we're doing skinny. Now we're doing tapered. It's that same thing. So they get the inventory late and they have whatever was last season's style and people don't want to buy it. So they have these inventories, which it costs them to hold inventory. Most companies don't like to have inventory. We have a what's called a just-in-time shipping economy because you have to think if you have a warehouse and to store goods, then that's rent, that's electricity, that's utilities, that's workers, right? That's a whole bunch of expenses just to hold inventory. So what a lot of these companies do is they order it and have it show up just in time to move it onto their shelves. And they're going to have a little bit of storage, especially if you're a big box store. I mean, they have these big warehouses where a lot of the stuff sits and then they move it from those to the local stores where you and I would find it. But this just-in-time shipping economy saves them money, right? They don't have to pay rent for a building to hold extra stuff. They don't have to pay employees. They don't have to pay utilities. But what's the downside to that? When the shipping chain gets disrupted, your product line gets disrupted. So now they have to scramble to cover, and that's what they did. They over-ordered because all the fears of, number one, the China tariffs and the trade war from a couple of years ago started this whole thing, and then the pandemic closures exacerbated it. So you have all these companies that like super ordered inventory when they shouldn't have, and now they can't sell it because people don't want to buy the fashion stuff that's out of date or whatever things are out of date. So what Target is doing now is they're going to start selling this stuff at a discount to get rid of it, which is good for shoppers, and it's somewhat good for the markets because it shows that it's a marker that inflation could have peaked. I don't necessarily think it has peaked yet. It's possible, but I think we're kind of in the process of all that. Because the numbers that we get are from the previous month. So whatever we're seeing now has already happened. So that Target having to do that was actually kind of bullish because it showed, hey, they're not making as much money. They have to get rid of this inventory cheap. So that's a good sign. But everything else is still expensive. Everything else is still inflationary. So it's only one bullish thing amongst a whole bunch of bearish things. All right. So the point of this chart was just to show you that we have a rough couple of months. We've got this next rate hike, which is probably going to be more. Then we have earnings season. And on August, there's a break. There's no Fed meeting. So we don't have to worry about anything there. But once we get through August, because there'll still be some earnings going on here, we're going to enter September, which is where the next meeting is. And they've been saying for a couple of months now, September is the big month to review everything, which is why I think things are at least probably going to drop until here, right? And if the war in Ukraine lets up, that's the one thing that could pop it and turn things around. But if that doesn't go, or if it does end and there are still issues with oil and still issues with food, then it's going to take some time to clean out through the system. So I think that's mainly why they're saying September. It's because they want to like jack the rates up really quickly, see what the effect is, because it takes some time to bake in. So after a couple of months, it will have, and they could say, all right, are we going to be more aggressive? Are we going to slow it down or what? So I'm looking at September as the chance to, if we're going to have a bounce, start the bounce. But I don't necessarily know if it's going to start here or if it's going to start later, because if inflation continues to be out of control, if the war in Ukraine continues, if the shipping situation continues, they're going to have to keep going, which is why I have 25 to 50. But up here, if you look at Kashkari and Bullard, I've got 50 to 75, because a couple of them are saying, nah, we at least have to do 50s for the rest of the year. Because Bullard was saying 3.5 is the target. And if you're going to do that, you can't go less than 50 by the end of the year to get that target. So they're going to probably have to hit 75 here and then 50s across the board or whatever it ends up calling for. So what do we got here? Earnings season and Fed day. Then we can cap. Only moment to do it. Yeah, that's the big thing. We have all this volatility. So after September, things might start to clean up a little bit. I think at that point, we should hopefully have the shipping situation dealt with a little bit, because a lot of these closures, like the zero COVID policy in China, where everything is closed down, is one of the main drivers of this. Because you have to think China is one of the main suppliers to the entire world of goods. I mean, it's so cheap to get things from China mostly, and they also make good things that are expensive as well. You can get a whole bunch of different stuff from there, but their main export is the cheap stuff, and that's what people mostly want because that's how they make the most amount of money. Let's see. Until then, no news or no new news. They'll escape positions at 36 to 38. If it goes up, I'm assuming going to be a boring month, like a month ago, stuck at 4,100. It might be a boring month. I'm going to say the boring month is probably going to be closer to the August area, like after earnings season, because we've got, well, I guess it'll be boring up until this point because we've got a couple of weeks. But you know what? No, it's not going to be boring actually, because there still needs to be a shakeout in the market of everything that just happened. These rate increases and the Fed's bond policy and the outlook in the general economy has changed rapidly. So I think there's going to be a reaction. Like next week, my guess is that we're going to continue to have that drop. There might be a little bit of a bounce, but I don't see rallies lasting. Anytime a rally happens, it's actually bearish for the market. This is what's so interesting about this time and what a lot of people aren't realizing. Rallies are bearish right now. Number one, because of the rates. Number two, because, inflation, supply chain, blah, 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 the thing I've said a million times. But number three, because rallies tell the Fed we need to tighten harder. So that's what you need to look at. You need to look at oil and how far oil's going up. You need to look at the general market and then pay attention to everything else as well, because that will tell you if we keep having rallies, the Fed is going to crush them. The Fed is going to make sure that these rallies don't last until inflation comes down. So we have to wait and see CPI. If CPI drops, then that's extremely bullish, right? The two main things that we want to see are the war in Ukraine end and CPI come down. Either of those things would cause the market to bounce early and would cause the Fed to slow down their pace that they have recently said they're picking up. Let's see. So 41 to 36 was the reaction. Yeah, I mean the reaction from the rest of the entire year. Here, let me bring this down and bring the thing back up. So where would 41 have been? 41 is around here. Oh, you're saying from the top of this little move right here. Let me zoom in a little bit so we can see that better. So you're basically saying since this is around that 4100 mark, the reaction was down to here. So you're kind of thinking maybe it's over. It might be. I'm not sure. I was expecting Friday to be a little bit more down with how Thursday went, but that's why I'm thinking there could be a little bit of a bounce next week. But any rally is going to get crushed, and people know that. Like the Fed doesn't actually have to do anything. Let's see those last days. Yeah, okay, yeah, that's what I thought. You were kind of talking about that little spot right there. So this was the reaction, and is it over? I don't know. I mean, you look at the so this would have been the first Fed meeting right here. These 3 weeks of green. So you had like a 3 week reaction, right? And the next Fed meeting was somewhere around here. 5/9, 5/16. Yeah. So this would have been the next Fed meeting. So there was a bit of a reaction afterwards, but it didn't last, right? The other one lasted 3 weeks. This one lasted one, and then it kind of topped out and fell back down. So each rally is getting crushed earlier and earlier, right? We had 3 days, we had 3 weeks, we had 1 week, we didn't even have a week. Right, this last one didn't even have a week of pumps. So I think that it is likely that we're going to keep dropping. So what we got here? Consumer Delirious, I love how fast you talk. It feels like an auction or like Wall Street announcer. Yeah, that's my thing, man. I talk really fast, and when people aren't interested in stocks, it annoys the hell out of them. So that's why I wanted to come on here and stream because it allows me to get all this stuff out, and hopefully it helps somebody that likes what I'm saying. So I'm just gonna basically have diarrhea of the mouth and talk as fast as I can because you need to get the show done before I try to finish between like 5 and 5:30 to get out of here and get the rest of my day going. But appreciate that. Nice. I'm glad that you're in here and checking everything out. So let's see what else we got. Future Space G all repositioned at the 3650, so probably a timeout just in time for hedges to fake pump again and escape some of the positions higher. Yeah, and that's what we're waiting for. We're waiting to see if there's going to be a bounce because there really is a lot of pressure downward on the market. So I mean, every single week someone comes in and tells me that the market's going to bounce, right? Every single week, and even it does bounce sometimes. Obviously, as we can see, there's a bounce here, there's a bounce here, but ultimately, what's the trend? Right? The trend is lower every single time. Every high is a lower high, and that is very bearish to traders, especially short-term traders. And if you look at everything else, it's below the moving averages. It's at a point where the volume is extremely low. So if we back out a little bit here so you can see better, this is not very strong support. I mean, there's just so many reasons why I think this is going to go down. So any bounce that happens, my personal opinion, and obviously this is just mine, like I said, I'm not a financial advisor. I don't give financial advice. I'm just telling you my opinion and telling you what I do so you can make your own decisions. But my opinion is that if we have a bounce, it's going to get crushed. So I'm using it as a chance to trim anything else. But I have mostly already trimmed everything. So it's going to be hard to decide what to trim. But what I'll probably actually end up doing now is adding some shorts. Because I have a few shorts, there are a few companies that I just know are going to get crushed, like Rite Aid, for example. Unless it has some personal news, it's mostly going to get crushed because it's a money-losing company. If you've ever been into a Rite Aid recently, it looks terrible. I probably say this almost every single week, because it's just an obvious company to me. There are tons of companies like that, but to me, I know it because not only do I know the stock, but I know the company itself, and I go into the stores anytime I see them just to see what they look like. That's one thing that is overrated. If you're trading something and it's something that or something that's in your area, go in and look at it, and ask the employees there about it. Like when I'm checking out, I try to ask them about financial things that they might know, like, oh, it's like, it seems like there's a lot of people here now. Have they been hiring lately and stuff like that? Just, casual conversation that is small talk to make, conversation with them, but it's also a way to get information. So I talk to Rite Aid people and they never have anything good to say about the company, so it's yet another thing to tell me it's a good short. Now, I like to short it when it pops. Like every so often, there'll be some news that comes out and it pops up $2 or $3. That's perfect for me to short. But anybody that shorts, you have your own thing. You were talking about Bitcoin earlier. Bitcoin's probably a good one because as much as people don't want to admit it, it is tied to the market and it's going to move with the market because most of the major players are also in the stock market. So you have to watch anything that affects the market is going to affect crypto. It is not yet a hedge. There are probably altcoins that are a hedge, but Bitcoin itself, which is the ruler because of volume, because of market cap, it's going to follow the market. So it's another nice short. So I like these bad companies. I like crypto. I like shorting the indexes right now. As long as you're within the amount of cash you're okay losing if the move goes against you, because you never know. I actually heard I've heard rumors about Putin or wanting to finish this thing, wanting peace in Ukraine. Now, you never know because I mean, I'm getting news third, fourth, fifth hand, and I'm just some random guy, in America. So who knows? But I've seen a few stories like I think, and I remember hearing that Russia achieved most of their objective like 2 months ago. They only had like one objective left at that point. So I'm assuming they got it or they're about to get it, which is why Putin is saying, "Hey, we want peace. Maybe we want to negotiate again." It could end suddenly. Who knows, right? There's also the rumors about Putin's health and whether or not he's dying and stuff like that. So there are factors that could lead to things stopping early. And if that happens, you don't want to be too overexposed to the upside, right? If you're all down, if you're all downside, and it goes against you, that's going to hurt. So that's why my philosophy is to use as many a diversity, not of just stocks, but of strategies and brokers, right? So my idea is, and I know the people that are here every week hear me say this all the time, but I'm going to say this for people that aren't here every week. I like to have multiple strategies. I like to invest long term and I like to trade. And I like to take the trading profits and use some of them to grow my account size, but use the rest of it to buy more in my long account. Right. So trading can hedge during these down moves. And people that are just dollar cost average upward long traders or investors, I should say, usually are right. They're going to win most of the time. But during these points, they're getting destroyed. Right? Everyone in my family that owns stocks, they're all long-term passive investors and they're getting crushed right now. Because they don't do any trading. Me, however, this has been a great year for me. If things keep going, this will be my best year ever. And last year was my worst year ever. The one where everyone was making money was my worst year ever. And now that people are losing, I'm doing well. And that's why I like this strategy of doing the long account and the short account. Because if it bounces, I'm covered with my long account. And if it keeps going down, my shorts are going to be bringing me little bits of income as time goes on. That theta decay is wonderful. And also delta, because it's moving downward. So delta is going to be working in my favor as well for options. Let's see, Magic 0318, want to become famous? Buy followers? Oh yeah, I would love to, but I don't think anybody's going to care that much. Thanks for letting me know though. I appreciate it. So what else we got here? I missed a few comments, so I got to go back a little bit. So consumer Delirious, what lever arm is best for this trend with bear certificates? These bounces back leads to losses. He's earning a lot of money by keeping the war on. Yes, Putin is definitely. And what's the best lever arm? I don't use leverage actually. If you can if you want, that's your thing. But the reason I don't use leverage is because number one, I don't want to have to pay the fees every month or every week or whatever, depending upon what your broker does. Number two, I don't want to get a margin call if things go against me because a lot of times people get squeezed not because they wanted to get out, but because they were forced to by their broker. Their broker called them and said, "You are below your margin requirement. You need to sell now." And that's basically what a short squeeze is. It goes up because a large entity starts to cover their position, that which makes other people who are short get margin calls and have to cover their position. And if you think about it, that short squeeze will probably be over within a day or two. But if you are forced to get out of that, you're going to lose. But if you have the ability to wait that out, you can either up your average a little bit and make some more money, or just wait it out and get back to where you were profitable. So I don't want a margin call to ruin my trade, especially if I have conviction in it. I don't want to have to sell stocks in order to cover my margin cash requirement. So So if you'd have to talk to somebody that's more into leverage because I really am not. But yeah, I would just say whatever. If you have a financial advisor, they would know the best. Otherwise, just look at the different brokers and talk to them. Ask them what their policy is because some brokers charge you so much in fees for margin that it's not worth having at all, especially if you have a small account. Now, if you have a larger account, using margin is great, especially if you have an account over $100,000 and you can get portfolio margin. That's the best kind of margin because it will be so much easier to make moves and to not get margin calls and get squeezed out when things don't go against you. But if you don't have that much money in your account, then you're looking at options that are going to be a little bit more expensive. So it depends upon the broker and it depends upon what you're looking for. So you'd have to talk to them about that. So let's see, Future Space, you've been chatting up a storm. I've been missing what you're saying. So let me get over here. Let's see, we'll get temp in stock since hedges have over 50% of the market and their options just expired. Yeah, see, quarterly options expired this week. So that's their next week could be a big move. I didn't finish that point, did I? Yeah, so I turned off the rollover time and the contract expiration because it gets in the way. But the reason I like to have that on is because you'll notice when contracts expire, the next cycle has a big move in one way or the other, starting right at that first day. Not always, but a lot of the time. So let me go into we're in equities in this case. Okay, well, I guess we're not doing that for whatever reason. It's not showing up, even though it should show up. Let's just say normally you would see a change in the direction when contracts shift over, which is also why I think a bounce could happen. Because we've had all this downward pressure, it's about time for a bounce. A new contract cycle is starting because we're starting Q3 coming up pretty soon. So either we could get a panic through this area of low support or a nice bounce that probably won't last. And if it does bounce, I'm looking at most likely a lower high because we keep having these lower highs. In fact, this security right here, I have already drawn a line, and let's see how well that line is holding up. So let me extend this line a little bit because it's um oh man, I moved it. Oh well, but we'll maybe do it more like that. That would be kind of a little bit more accurate. So we're looking at maybe coming up and hitting somewhere in this area, maybe up by the averages or the highs right here. And you can see this is where volume comes in. So this is why this is a good little top. And Future Space G, you were talking about that 4,100 mark. That's probably why, because there is volume right there. But since we have this brand new contract cycle, I'm thinking there's going to be a really volatile move coming up. So if we have a bounce, I'm looking for that 380 to 4,100 level as a place to bounce down or bounce off of and continue possibly lower. If things pick up, then we're going to keep going up from there. I mean, if the war stops or whatever, that's extremely bullish. So that's what we're looking at with market movement. Let me get into. Let's see, did I cover everything you were saying? Let's see. If your $500 came up for fun, use leverage. Oh, you're talking to him. Okay. Bounce will be small, but if we don't break 3650 now, hedges need to place the money into stocks temporarily. Well, see, that's the other thing too. There's a fight between the bond market and the stock market right now. The bond yields have been going up because people are jumping into these things. Everyone's afraid of a recession, of a stock market crash, which I guess you could already call this a crash. So bond yields and safety stocks are the place to be right now. And we don't know if they're going to stay safe or if they're going to continue being what they have been. But if we go lower, then the bond market's going to continue gaining. Oh, so here was one interesting thing before we get off the Fed rates. The 11 members of the FOMC all voted to do the 75 basis point hike, but one member dissented because they were worried about how fast this was going. So the fact that most of them were in tune with each other, but there was only one dissent, tells me that this move is much more real, right? It's what people actually want, but there is some concern. So if we continue to do these high moves, I think the Fed is going to get much more divided. And at some point, that's kind of what we're waiting for. If you had a chart on the Fed, where's the support and the resistance for what they are going to be picking as far as their rate announcements, right? So I would say that at some point, when the dissenters equal the amount of people that are for the move, that's when we're going to start having a pause in rates, or at least that's when we'll be close to having a pause in rates. And we're probably going to get up to that 3%, which is very likely. So we got a lot of downward motion. We talked about splits. I don't think we said anything about the tariffs, but there are some China tariffs that are going to be that are considering being eased right now to help with inflation a little bit. The other thing is commodity prices are going to be out of whack for a while, so even if everything else catches up, commodities are still going to be bringing things down, mostly oil, but also food. So we got to watch that. That's the main one. The good sign though is consumers are spending. There is no sign of a broader slowdown, and that's a quote from the Fed saying that because spending is strong, things aren't as bad as we think, which is true. If people are out there spending money, then these companies are still going to make money, which tells me that next earnings season could be a bounce, and that's one thing I'm waiting for. I love a really bad earnings season like we just had, where everybody guides down, because that leaves the possibility for a bounce on the table. Now, I don't know if this next one's going to be a bounce, but if the next one isn't, then the one after that probably will be. So we have a good possibility for a bounce, and I love that. So I want this move to continue going into that next earnings season, because that gives that possibility of a bounce even more merit. So we're looking at that. We had a couple of people. All right, here's so people are always starting stuff on TV, right? You got these analysts coming in and saying like, "Oh, the market's going to crash." But we had one guy, was it Shark Tank dude, Kevin O'Leary? He was saying the Bears are wrong. Like, specifically, you're wrong. Show me the numbers, right? He's basically saying all the numbers look good, and he's right. Spending is up, investment is up, saving is down though. That's one thing. Saving hasn't been down for a long, long time. So some of the money that's being spent isn't all new money. Some of it is reserves from people that have been holding money for a while. So that is one kind of bearish point. But the other thing I like is consumer sentiment is super low. The lower it gets, the better it is for a bounce, which is why I like that later in the year time frame for a bounce. There are just so many things that are saying, like the fact that all this bearish stuff is weighing on the market, but the core part of the market is strong, is a wonderful thing. And that's what people aren't looking at. When you see the perma bears, the people that are telling you that the dollar is going to collapse and we're all going to die and everything's worse and the most horrible things you can imagine are going to happen, and the next crash is going to be worse than 2008. It's going to be worse than 1929. Those people, they're not looking at core, or actually what they're doing is they're trying to get clicks. They don't really care. They want you to buy their gold, because mostly that's what's going on, or they want your views and clicks, because they know a bearish video is going to get way more traction than a reasonable one. And see, that's why another reason why I wanted to do this, because every streamer I see wants to go to extremes, right? They either want to go way overboard on technical analysis, or they want to go to extremes and scare everybody or tell everybody that they're going to be millionaires. I want to come out and be boring. I want to come out and tell you, listen, there are reasons that things are going to be okay, right? We're not going to get this huge bounce right now because there's way too much pressure. It's like trying to bench press twice as much weight as your max has ever been. It's not going to happen if you haven't worked your way up to it, right? That pressure is still pushing down. The weight is going to fall on top of you. You might hold it up a little bit, but it's too heavy. And that's what's going on with the market right now. It's too heavy. We're not going to get that bounce without some of that weight coming off. So that's what I've been saying. The core is strong. So once the weight comes off, we can lift that weight. We aren't injured on the bench press. There's just too much weight on the bar at the moment. So that's a good sign. The fact that we have good numbers for most of the thing. Inflation is not good, consumer sentiment is bad, but the spending and investing are very strong still. And the PPI wasn't up quite as much as people were expected. So inflation in the producer market isn't quite as bad. It's still bad. It's still over 8%, but it was 0.3% below estimates and 0.5% less than last time. So that's a good sign. The last thing I have down here, mortgage rates. That was the one thing I wanted to say before we move on to stocks. Mortgage rates are still a problem. Jerome Powell came out and says, if number one, he doesn't think mortgage rates are going to come down because the supply is still short, right? There's still a shortage of homes and people still want to move. Most of the big moving, I think, has been done because of the pandemic, but there's still high demand because I think some of these people want to move again, right? And there's housing that's needed. So even with interest rates coming up, there's mortgage rates probably aren't going to drop for a little while because of that supply chain. However, the higher we push things, the more likely that is going to happen. And there are fewer people buying homes right now. It is the slow season, yes, but that's adding into it. So what do we got here? What about the coming heat wave on US this week and the coming week? 100 plus degrees for 100 million people. How can you earn money on that? Rising energy prices, gas, Coca-Cola. Playing a heat wave, You could go with energy companies, I suppose, on that. I'm not as good with the short term stuff. Something like a heat wave doesn't give me enough for my personal trade, but if you're looking to do something on that, I would look into either consumer or energy companies because they're an interesting player right now anyway. Also, yeah, here you go. Here's the thing. Instead of thinking about the heat wave, you can think about summer in general and the fact that the 4th of July is coming up in the United States, which means there's going to be an uptick in the amount of gas bought. There's going to be an uptick in the amount of food bought, and it could increase inflation for the next number. So you could look at it as kind of a slightly longer term swing trade. I don't know what your longest time frame is, but if you want to look out to maybe the next month or when earnings season comes out, you could look at that being a driver of inflation, or you look at it as an uptick in energy, right? People are going to drive more oil is going to be needed. Everybody's got their air conditioners on, so electric companies are going to be raking in more money. All their costs are up, but yes, that would be maybe one way to play it. Other than that, I'm not sure. That's not usually my kind of thing, but it is an interesting thing to look at. There is definitely something to be made there. I'm just not sure what it is. So Future Space G, let's see what we got. Let's see, the heat wave in the EU too. Every summer it's getting worse. Yeah, it's pretty bad in a lot of places. Where I live, there's been a drought. I live in California in the US, and there's been a drought for years, and we kind of had a little bit of a reprieve, but it's coming back in. I really don't know how to play that in the long term, but I'm sure there's something to be made. Yeah, you're welcome. Definitely bring any of those things, bring them up, man. I want to talk about stuff. Half of the reason I started this stream is to talk to people about new ideas because I want to learn too. I consider myself an intermediate trader. I've been trading for like 4.5, it's almost 5 years now. I think in another 2 months it'll be 5 years. So I'm obsessed with it, and I spend so much time learning about it and trading and investing and doing all that. But I'm still an intermediate. That's my goal. Like if you look at the Dunning-Kruger effect, you think you're an expert right away, and then reality kind of brings you down, and you don't think you know anything, and then you're kind of on the uptick. I would say I hit that down uh, part and I'm maybe coming up a little bit, but I still feel like, there's a lot that I don't know. So I want people to come in and discuss these plays. Specific stocks, for example. I love going into SEC filings and tearing apart these stocks. By the way, I stream every week the same time, Sundays at 3 p.m. Pacific, 6 p.m. Eastern. Usually that's when the futures market opens. So I like to see the open and see if it gives us kind of an idea of what's going to happen with stocks during the week, and then talk about what happened last week and what my preparation is for the next week. And that's kind of what we're moving into. We talked about everything else here. All the rallies are going to get crushed most likely. The Fed's cautious about too much front end loading, meaning they're not sure about jamming the rates up really high, but at this point it looks like they're going to keep doing it. So that's a downward kind of thing. So that's what we're looking at. We're looking at downward pressure. So what do you do? That's what we need to come down to. What do you do when you have downward pressure? If you're long, you trim whatever you're not sure about, and you buy the things that you like slowly. If you're looking for trades, shorting would be the best bet, and shorting over the long term. Because if we get a bounce, you don't want to get caught up in that. You want to start small and add to your position on any rallies, if that's what you're doing. And like I said, I'm not a financial professional. I can't give you financial advice. This is just my opinion and the things that I'm looking into. So that's kind of what I'm doing. I'm a little bit short right now, and I'm looking to get shorter into these rallies. You have to pick your own stock. Because I say this all the time, but every trade I've ever gotten from anywhere else has never worked. None of them have worked. I got a trade. I remember I was in a group with this trading guru when I first started, and that was the first time I lost a big amount of money. It was when this guy said, "Oh, I bought this stock, so I bought it too." And then 10 minutes later, he was out of the stock, and it was way down. And he basically just traded it. He dumped it onto his followers, and I had to learn that lesson the hard way. That's what happens when you get into these trading groups. They're nice because you meet people that are also learning, and you can learn a lot, but trying to trade off of their alerts is not that good. So that got me crushed. I watched some videos where people said this is a good idea. I looked into it and thought it was a good idea too. Got crushed on those. So never take a trade that anyone else tells you. You have to be sure about it on your own, because most likely you're going to get crushed if you do. I mean, you might get in at the right time and get lucky, but you have to pick these trades yourself. So what I'm doing is I'm trimming the long stuff. I'm buying the things that I like in the long accounts, and I'm getting short for the midterm and short term kind of trades. And anything that's short term, I'm making sure is an extremely small short. I'm using options, so I'm either shorting a spread, which means that I'm selling one option and I'm buying another one above it or below it to protect myself. Or you could just straight out buy puts, which isn't too bad in this environment because things are moving down. But I don't like going long as much. I like to short using short contracts instead of long puts because that allows me to drain money out slowly. Because even if it doesn't go in my direction, if it just stays going sideways, the value of those contracts is going to drop. So shorting will make you money whether it goes flat or it goes in the direction that you hoped. But if you buy long puts, you have to have that move because if it goes sideways, your put is going to lose money. So I do have some long puts right now, but I'm mixing too. I have a little bit, I have some long puts, but I mostly have short call spreads because that's my idea. And if we bounce this upcoming week, I'm going to use that to short a little bit more, get more of those call spreads, maybe some more of the long puts, but I'm not sure. So what do we got down here? There is trading group. There are trading groups. Is it on Discord or where do they hang out? There are all different ones. The one I was referring to was a paid trading group that you can get into. It was like $80 a month for the bottom tier, and these groups. Yeah, you don't. Here's my advice: do not pay for these groups. Don't pay for courses. Don't pay for groups unless you really want to. If you have the money and you can find a reasonably priced trading course, that's fine. I completely encourage that. But you can get all that information for free on the internet, which is why I say don't do it because I did it and I found everything that I learned from those groups and those courses on the internet and more. But the other thing, you'll get experience on your own anyway. So my advice would be to look for a trading group. In fact, I have a Discord in the link. There's not much going on in there right now because I just kind of set it up and I haven't really gotten a lot of it going. But I'm trying to get some people into that Discord, the Astocalypse Discord. I also have, by the way, some videos on YouTube. So if you don't catch these streams, I kind of edit them and put them up there hopefully the next day, maybe the next 2 days. But look into some Discord groups. That's a good place to talk to people. You can go on Twitter and look for some groups. There's a lot of toxicity and craziness on Twitter. Yes, I understand, but there is also some good stuff on there too. But don't get caught up into anybody that's way overly into some idea. If they're telling you this is definitely going to happen, don't listen to that person. Even if they were right and it does happen, you don't want to get into anybody that is too sure because that's how you get crushed. So watch out for that. Look for different groups for sure. Definitely go on to, if you find some YouTubers that you like, they'll usually have Discords. If you find some people on here during market hours is a good place to find some good stock traders that are actively trading and have Discord groups. But yeah, look for some groups like that because those are definitely places to learn some stuff. And anything you find, come on stream. Every weekend, like I said, 3 p.m. Pacific, 6 p.m. Eastern, I'm streaming. I'm trying to talk about things. I'm trying to get as much new content every week as I can. So come on back and talk to me then and bring some more stuff. So let's get into. I got to get going here in a little bit. So let's get into the last section here, the specific stocks and the crypto news. Right. So we had a couple of good earnings this week. Oracle, for example. So let me go ahead and pull up Oracle's chart. They had a really nice uh, earnings beat. Their EPS came in at $1.54. The estimates were $1.37, so that's a nice little beat there. They beat the revenue by a little bit. It was 11.8 billion. The estimates were 11.6. So that's a good sign. The fact that they made more money with the same amount of revenue, even though they beat it. I'm going to say it's still about the same amount of revenue that was expected. And that's a good thing because a lot of these companies have been beating revenue estimates, but losing on earnings per share. So EPS stands for earnings per share, if you're not familiar with that. And it's basically a way to tell what you would make if you took all the earnings of the company and you divided it by every share that's out in the public market. And what you would get is everybody owning shares has earned $1.54 from those earnings. Now that's just kind of it's not an exact thing, because that doesn't mean the stock is going to move by that amount. It's going to move by more than that amount, probably, because traders are going to react to that. But what it tells me is how well they did with the money they spent. So they spent sorry, not they spent, the money that they made. So their revenue was 11.8 billion, and they were expected to make $1.37 a share, but they made $1.54. So they made more than expected, which most companies are not doing right now. So that was extremely bullish for Oracle. If you look at their chart, they had a green week, and actually, if I switch this to the daily, you can see that the day that the earnings came out was actually a nice little pop. So right here, earnings came out, boom, next day, huge pop. Yes, it's red, but that's because the market was also going down and this movement was overdone. But that I like that. A company like Oracle, when they're beaten down, they're a good one to look into because they're so strong. They make they are not as affected by the recession because their product is mostly software based, right? They don't have to worry about shipping physical goods that much and storing things. So the fact that they beat on that and people were surprised was a great chance to make money. So Oracle is a company that I'm watching a little bit. The next one I'm watching is FedEx. Okay, so they have earnings coming out next week, and they're a shipping company, so they're in the sector that's really troublesome right now. So let's go to FDX real quick. Their chart had a little bit of a pop the other day, and that was because they announced that they're raising the dividend by 53% to $1.15 quarterly. They also added two directors in this deal with the activist D.E. Shaw. They have earnings coming up on the 23rd. So what day is the 23rd? That would be Thursday. So their earnings are Thursday after hours, which I'm going to be looking for. So FedEx is a company I like. The fact that they already popped like this makes me think that I'm not really sure how I would trade that. And look, there's contracts. Look at these red lines of the contract cycle. Remember the thing I was having trouble getting up or getting to come up like 20 minutes ago? Well, here they are. I don't know why it wasn't coming up on the biggest ETFs around, but hey, whatever. We got them now. So, and actually, I want to turn them off because they're annoying me, and I need to see things a little bit better. So that's really frustrating. That's the one thing I don't like about I'll leave the year marking lanes on. About Thinkorswim is sometimes it's a little bit buggy. That's a little better. So now you can see that it came up when they announced that dividend. I mean, a 53% increase in dividend is huge. Usually companies increase their dividend by a few percent, single digits or whatever, and they do it regularly. But because this activist investor wanted them to as part of the deal to do that, they had to, and that's extremely bullish for the shareholders. If you were holding FedEx, you're going to get a nice $1.15 dividend after getting 75 in the last one. So you can make a huge amount of money, and also the price action went up. So there's something I'm looking for on earnings. If they crash down, here's the trade. I just actually kind of realized it. If they crash down on earnings, they're a trade in the future. So I'm not thinking about them for right now. I'm thinking about them if they get crushed, going long later, letting the market kind of drown them out a little bit. But this increase in dividend is huge, right? And the fact that the dividend's actually coming up soon will also, because usually when the dividend is paid, there are a bunch of people that get out. So a lot of times you'll see a drop on the day or the day after that the dividend is paid out. So that's what I'm going to kind of look for. I want to see if they get crushed on earnings, which I don't know if they will. It depends upon how profitable they've been with this huge increase in shipping costs. My thought is because of that increase, they're going to be profitable. Most likely. I mean, shipping has gone up like 1,000%, literally 1,000% or more, which basically means 10x in a very short amount of time. So a lot of that is because things are clogged up and there's not as much flow of goods into where they need to be. So these shipping places are probably paying a lot more to get things done. And also the cost of gas is way up, so all their planes, all their vehicles, that's going to be expensive. So I really don't know. I would expect that they're going to be up, but I don't know. So I don't want to trade them beforehand, but if they get crushed after, I like them for a long trade. So I'm keeping that in my list. I have a Sunday Night Finance list over here on the left side of the screen, and all these stocks are the ones I've been talking about for the past couple of weeks, and I like them as trades or they're things I just want to watch. So FedEx is one for earnings on Thursday. That's definitely something to take a look at. So Twitter's been they're in the news pretty much every week. They had a little town hall meeting. I actually didn't check it out. It happened on Thursday, and I think it was leaked by some company right after that or something. So it's out there, but I really didn't take a look at it. So I was planning on doing it before this broadcast, but so much stuff happened this week that I didn't have time. So we'll have to see what's going on with Twitter later. I don't know how that went. If somebody else knows, maybe you can put it in the chat. But we'll have to save that for next week. Okay, we talked about Tesla. We talked about the Qs. Here we go. Here's an interesting one. Revlon, company I really don't care about and I don't pay any attention to. but they filed for bankruptcy. So if you want to see something funny, they filed for bankruptcy. And look at their chart, right? This news came out sometime this week, and look at what happened. They bounced. Why did they bounce? Right? This is what happens in stocks that are failing. And this is the interesting thing that I want you to look at. When there's a failing stock and you know things are not looking good for it, they'll announce some terrible news and it'll bounce sometimes. That right there tells me that this stock is going to be extremely volatile, so there's probably a chance to make some money. I mean, you look at this huge red candle, and then you look at this bounce. It was probably somewhat of a short squeeze. I mean, it's a dollar stock at this point. They filed for bankruptcy, and they're a New York Stock Exchange stock. So I don't know what the listing requirements are for the New York Stock Exchange. It's probably similar to the Nasdaq. The Nasdaq has a $1 limit, so if you're below that, they need you to be above it for at least 30 days or 15 days or whatever it is to stay listed. So they're probably going to go back and they're going to do whatever they can to pump their stock. So having this little $1 mark right here as a chance to maybe make some money is not a bad idea. So I like this bounce. If I can short it, which I don't like shorting with contracts when the stock is like $3 or less, because let's take a look and see if it even has any contracts. It does. And let me guess, they're going to be thinly traded, right? Yep, very low volume on all of these. Well, actually, that's not bad. 5,000, that's a decent amount of volume. 3,800 open interest. So yeah, this is the contract cycle coming up. Let's move it down a little bit. Low, 3,000. Okay, there's some volume on these. I guess you could trade these. But do I want to buy puts on it? Maybe, but not real. I don't know they don't have $1 puts. They have 250s. I guess you could go on that. And what kind of money would be in the calls? Nothing, right? So you got a $2.50 wide spread, so that's $250 of risk to make nothing. Because this contract has to be higher than this contract in order to make money, and this one's lower. So if I sold the 35 and bought the 55, I would be putting $250 of collateral on hold, and I'd be losing $20. So this is not a trade I'm willing to make. But that's too high up. Would I want to short it here? No, can't make any money there. What about here at the money, basically, or close to the money? No, still not good. I don't like any of these. Right, these are all terrible. So Revlon is not something I'm going to be able to do on the short side. I could go for long puts if I wanted to. But if it continues to bounce, if it goes up a few more dollars, then I might think about it. But because it filed for bankruptcy and bounced, that just told me right there. That's the pattern that says, all right, this is going to be volatile. It's probably going to continue to go lower, but it's going to have this $1 resistance that it's going to have a little trouble breaking through before it probably eventually does. Unless somebody comes to the rescue and buys them. So I probably won't do much. These would be like very short-term trades. I'd like do it over a couple of days maybe. Like this would be a nice little short to ride down here if I could. But there's nothing. So this is just something I'm watching. I'm not actually getting into it. I'm just sitting there and watching. So what's the next stock we have? All right, Etsy. Those of you that listen to this broadcast regularly know that I love analyst upgrades and downgrades. Why? Because they move the stock almost as much as guidance does. The two main factors for moving a stock that you know about are one, guidance. When the company reports earnings, the actual numbers don't matter as much as what they say is going to happen in the future. That's the biggest mover of a stock that you know about. And that's going to happen every earnings season. They have to give guidance. Number two, analyst upgrades and downgrades. If an analyst looks at that guidance and then upgrades the stock or downgrades it based on that, that can be like a 2x on the move. So you'll see if a company gets a nice upgrade, they'll have a little pop. And Etsy did. What was the specific? Let's see. Analyst. Oh no, it's a downgrade. That's what. Okay, I'm sorry. So they popped. They had a pop for something else. I'm getting confused here. They got an analyst downgrade. They were cut from 140 to 120, which is very bearish. That's probably why they dropped after that. But and they were downgraded on not on the fundamentals of the company, but on the consumer spending side. Okay, so that was why I put it on there. Not that it jumped. It was that it's been cut on consumer spending. So we don't know if Etsy's actually going to go down, but because consumer spending which is the forecast. I should say the forecasts of consumer spending, because consumer spending is still strong right now, but the forecasts of it caused them to downgrade this, which is what I like about that. It's a very, I don't want to say risky downgrade, but it's a very up in the air downgrade because we don't really know what's actually going to happen with Etsy. They could be fine, but they rely on average people buying stuff from other average people on this. They're not, it's not like giant companies selling stuff to consumers or whatever. I'm sure there's probably something like that on there, but it's mostly just small sellers. So consumer spending plays into Etsy's consumer base heavily. So the fact that they were downgraded on a possibility leaves open the possibility of a bounce, in my opinion. So Etsy is something I'm watching for the future. If they get crushed again, they're another one that I like for a long-term play, not a short-term play. So what do we got here? Why are you not buying stocks which gives 15 to 25% dividend and monthly dividends? Why is 3% from FedEx good? Okay, so that's a wonderful question, actually. The reason you don't want to buy stocks that have a 15 or a 25% dividend is because that's not sustainable, right? If you think about it, they're taking 25% of their earnings and giving it to the shareholders, and especially if they don't have earnings. Because what a lot of these stocks will do is they'll up their dividend because the fundamentals of their business don't look good. And traders that are reading into that will say, oh, I don't know if I want to buy this stock because the fundamentals don't look good. So it'll drop, and then the company will say, well, we need a way to get shareholders back in, so we're going to raise the dividend, right? So raising the dividend up to an unsustainable level is not going to be good long term. It'll be good short term. Yeah, you may get some good returns initially, but because the fundamentals are terrible, it's going to keep going down. So let's see. We were talking about, like, why is FedEx a 3% good? Because FedEx is a wonderful company. They're not going anywhere, right? They're going to stay. And if you have a lot of money, you can rest assured that your money is safe in FedEx. Even if there's a drop, it's not going to be too much. A company that's giving you a 15% dividend is doing it because they're in trouble, not because that's a sustainable model. You won't see any good company giving you 15% dividend. I mean, okay, there's probably some that do, right? And you're mentioning REITs down here. What about REITs? I love REITs. REITs are a great way to make, if you're looking for dividend plays, a solid REIT is a great way to go because rent continues to go up, and they're going to uh, constantly be increasing their rent, so you're going to be making more over time. It's basically a guarantee. Also, real estate is extremely necessary. It's not some concept or whatever. So looking into REITs, looking into stocks that have a reasonable dividend, I like a dividend under 7% or under 8%. Once you get to like 7 or 8%, that's where a company starts getting into trouble. And some companies, like oil companies, they're at that point right now. If you look at like ExxonMobil and stuff like that, they're somewhere around that like 7-ish%, I think, because they have to. Oil is kind of, it's not a dying industry, but it's an industry that's in trouble. So that's one way to keep people there. And because they can actually sustain that dividend, it's not a bad one to look into if you're looking at that. So high dividends, I would steer clear of them just because of the risk. Yeah, you might have a good dividend return, but look at the price of the stock over time. It's not going to be good. It's going to go down because the fundamentals aren't looking good. So the question is the dividend enough to offset that? And is it enough to more than offset that? Are you going to be able to make money on that? Or at the best, are you going to break even? Most likely, what's going to happen is you're going to lose money and you're not going to make enough in that dividend to cover that up. So if you're nibble and you take it for like a quarter or something, yeah, that's good. You may be able to trade that. But if you're looking for a good return, I would look for a safe company, because when things go really, really bad, those companies are the first to get destroyed. So yeah, good. Yeah, exactly. And that's something that you'll see on your own. It's, if you haven't noticed, if you haven't been in the market long enough to see that kind of stuff, eventually you will be, because that's a very common thing. Like, especially in a bull market when everything's going up, you'll see, actually you'll kind of see dividends shrink sometime because the stock is making you more money. But when the times are hard and these companies are heavily indebted or something like that, and they need to pay back, they have a lot of short-term debt. That's a really good point. Look at short-term debt as far as companies, as far as buying into companies. Short-term debt will is another big cause of moves. So if that comes up to bite them, then that dividend's going to get crushed. So that was the point on that. And actually, that moves into my next thing: high yield growth. Right, HYG is a stock. It's had an uptick in puts lately. And what I like about that is that's telling me when bears start to really come in heavy, and they're coming in on this down move, right? Like the puts came in really heavily in this. So not so much as it's been going down, like this would be a great place to get into a put, but as it's down here, the put volume has shot way up. So that's telling me, even though it's a newer stock and there's not a lot of support behind it, it's not as good to measure these volume profile. Like this isn't going to tell you much of anything. But because there are so many puts, that's actually kind of a bullish sign for me. So that's one thing. When you see a bunch of people getting bearish and betting on a market dropping, then you have a chance of bouncing. And this high yield growth, this HYG's ticker, is mostly junk. Well, I don't know if it's junk bonds, but I think it is junk bonds. It's the high yield bonds that are much riskier. And when a market's going up, they're a great thing to make money on. You'll see a nice return from stocks like this. But because people are getting bearish now, that's one thing that makes me think, oh, maybe we are getting closer to a bottom. I don't think we're there yet, but we might be getting closer. So, all right, let me get to some crypto news, and I got to get out of here because I got a few things I need to do, and they're time sensitive. We had some crypto stuff that came in. Celsius pauses customer asset withdrawals. That was a big one. So people that have money in Celsius right now can't get it out. And their reason was for, quote, extreme market conditions. They might also have to sell some of their crypto investments to pay their clients, which will be very detrimental to the crypto market. So if you're holding crypto right now, this isn't a definite, like this isn't a guarantee, but it's something to think about because Celsius is a huge company. They have a lot of influence in the crypto space. And the fact that they might have to sell assets to pay back their clients is not good because not only is it, bearish for the fact that they aren't doing well, it's also bearish that they might take the market down more trying to cover that. So that's another reason why I'm buying slowly into crypto. I have been buying for like the last $10,000 on Bitcoin, right? Like up around 30% is when I started adding some more. Actually, I was above that, but I started adding heavier then. And if it dips below 20, if it keeps going down, my buying is going to increase. So hopefully, I actually kind of want that to happen. I want crypto to go a lot lower. I want to get back in, and we need to wash out all the weak hands so that it can pop again. All right. So the next thing was the crypto. We got some predictions. Some people saying that it's going to go even lower. We had one guy that said 20,000 was kind of, or 22 was kind of the bottom. Well, look at that. We're below that. I'm thinking more along the lines of if it drops even more, 15 to 10, maybe even 8. Like that 8 to like 15 range was where a lot of shares changed hands for Bitcoin. So if the drop continues, which I think is likely, that's kind of my next little spot that I'm looking at, and I would love to buy in there because that's where I let go of most of my crypto. I bought a lot of it in that like 3,000 range and dumped it around 12. And I didn't have that much when it went up to 20. I dumped another chunk when it went to 20. So I had very little going up to like 60K. All these people that made all that money, I was so jealous. That was another reason why I hated 2021 because I got out right before like the really big pumps happened. The crypto market cap dipped below 1 trillion for the first time since January of 21, right before the mania took off, right before GameStop and all that stuff. So it's very bearish right now. I am loving this 100%. The other thing is Binance halted Bitcoin withdrawals. Says they're having technical reasons. Maybe they are, but I think it's more along the lines of the Celsius thing. I think they're struggling right now. Everybody's struggling. That's crypto base. The other thing is U.S. crypto regulation bill. It's bipartisan. Is under in the works right now, and they're trying to get it over to the CFTC, which is the Commodity Futures Trading Commission, instead of the SEC, because they would have lenient rules, or it would have more lenient rules for crypto than the SEC would. So that's actually kind of a bullish thing. We want as little regulation as possible from a bullish sense. Now, what your personal opinion is on crypto is totally different. Like I do think that regulation is necessary in the space. I do want to keep it as little as possible because once you start over-regulating things, you run into problems. Like the things that regulation is trying to solve can become exacerbated when you overdo the regulations. So this going to the Commodity Futures Trading Commission instead of the SEC is actually a really good thing. So hopefully that goes through. It's in the works right now. It's bipartisan, so that's a good thing. When you have the left and the right on the same page on something, that's usually a good sign. So we're looking for that. The next thing is Coinbase. They're going to be cutting 18% of their employees. That's another bearish thing. And the last point, 1.6 billion of Tether was sold. The stable coin exodus, right? We had Gemini was having they had some layoffs. They were having problems. Tether's been getting dumped. Like there are a bunch of regulations in New York for stable coins. So stable coins are an interesting space right now. I never really got into them, but they're having some problems. more so than the rest of the market because of everything that's going on. So that was pretty much everything I had on the agenda for today. If there's any questions, oh, here we go. Let me get into this. Bull or bear on crypto today? I don't even know what the price is. I haven't even looked at the price of crypto. Let me get into it real quick before we get off. But on the day, my opinion would be. Let me open this screen up real quick and bring it into the other screen. Let me just look at Well, everything's up, so it's a green day. Bitcoin is up. This is my tiny little trading account. I have like $100 worth of Bitcoin in it. Oh, look, 116, a little bit more. But it's down 130. See, it's like, I was putting a tiny bit in as we're going down. So on the day, bullish. It's up. It's probably going to stay up until here's what you look for in crypto. It's very interesting. The middle of the night, right? On Saturdays and Sundays is when huge moves happen in the crypto space. So if you're looking for a chance to buy, if you're up, if you're in the United States or somewhere on the Western Hemisphere, and you're awake in the middle of the night and you see a huge drop, that's a wonderful time to buy. If you're looking for, short-term bounces or whatever, I don't know about that, but if you're looking for long-term, I love those like midnight dumps, West Coast midnight Bitcoin dumps. Man, I bought when the things were going up in 2021. That's how I made the little amounts of money on crypto. Like it would dip in the night, I'd buy it, and then I'd sell it during the week, so I'd make a tiny little bit. But usually with trades, you see, this is why I want more. I only have $100 at this thing right now. I want way more than that. I want to up this by 10x at least. So, I'd like to have as it goes down even more. And then this is just this one. I want to buy an Ethereum. I want to buy as many good cryptocurrencies as I can. But on the day, we'll call it a little bit bullish. Let's see, around which time in the U.S.? Oh, that was I probably already answered that because I had the question thing. But yeah, I like midnight dumps as chances to buy into that stuff. If you're looking for a trade on the week or something like that, those are definitely good spots. So yeah, crypto bullish on the day, bearish in the medium term, bullish in the long term. I do think crypto is going to improve. I think all altcoins are going to rival Bitcoin at some point, more so than just Ethereum, but it's going to take a little bit of time. Let's see, you're in Sweden. Is that Sweden? Or is SWE something that I'm not familiar with? So you're over in Europe. Hey, Future Space G is over in Europe. So he's looking at that, and I appreciate you guys watching this in the middle of the night or whatever it is over there. Like it's 5 in the afternoon for me, so it's normal. But I'm glad that you're taking some time out of your night to come here and check it out. So yeah, Sweden, good, awesome. I really hope you come back next week. I know it's a rough time for you, but I'm here at the same time every week, even though the markets aren't open right now because we have a holiday tomorrow. I'm still doing my show at the same time. The plan for the week is if we get a bounce, I'm looking short. Otherwise, on a drop, I'm just looking to add a little bit or let the market drop and sit in cash because I'm mostly in cash. That's why you see that $100 in Bitcoin because it's mostly cash. I don't want to be too heavily exposed, especially if Bitcoin ends up going down to 10K or whatever. So yeah. So that's what we're looking at. It's going to be an interesting week. Stay safe with your money. I hope to see you back next week. I appreciate the engagement. It's awesome to come and talk to people and meet new people every week. It's a small channel, and I can spend more time on the things you're talking about. And that's what I really like. It's a great little community, and it's just getting started. I've only been doing this for a few months, so hopefully I'll see you next week. Be safe with your trading. Take care of yourself. I know it's rough around there for everybody. So I'm going to get out of here. Have a good rest of your weekend, and I'll see you next week.